Susan, maybe I'll turn it over to you to sort of share the narrative of what we're about to learn today.
Well, welcome everyone, and welcome to the 360 Deep Dive on Africa, which is designed to raise awareness, I guess, and examine the opportunities on the ground and the challenges in full technicolor. We're going to be spoken to by experts in their fields across a whole series of different topics for about 10 minutes each, and then we'll conclude with our panel of 5. How far the dark continent has come in 150 years to become the world's biggest growth market. It's continuing to urbanize at a high rate. It's got problems involved with that, like employment and basic services. And that includes housing and sewage and food and various other points as well. Can it foster a different way to solve these problems and create a vibrant Africa? Can its governments create enabling environments, which is a very big question? And can it successfully transform from more of a frontier market to more of a mainstream market and apply technology and innovation and partnerships? Well, let's commence proceedings with Adrian Saville, who is investment specialist at Genera Capital, also a professor at the Gordon Institute of Business Studies at the University of Pretoria, and a director at the Center for African Management and Markets. Adrian, over to you.
Thank you. I'd like to share a screen. There happens to be a screen share up at the moment. If I could just pop this up, that would be great. Susan, thank you for the introduction. Given that we've got 10 minutes or so, I have set myself the incredibly ambitious task of getting through, believe it or not, 39 slides in 10 minutes. I'll do it. And I'll get from Cape to Cairo and Dakar to Dar. I've already been introduced, so we can do away with that. The backdrop to many conversations about Africa is exactly as was referenced in Susan's introduction, the dark continent. And these front covers are almost the poster children of perception for Africa. They are well known to this audience, where your typical or stereotypical visitor to an African market goes with a rocket-propelled grenade launcher over their shoulder. And the infamy is captured in photographs like Kevin Carter's Sudanese image of a vulture waiting to prey on a starving child. And this narrative is evocative, it's deeply emotional. It is not always incorrect, but it is increasingly misplaced and translates into misinformation, huge knowledge gaps, and very often naive perceptions of what is an incredibly diverse and in places exceptionally rich continent. Jonathan Swift captures this in a couple of lines of poetry a few hundred years ago, where he says the naivety about Africa led to geographers filling their maps of Africa with savage pictures, and in place of towns where they didn't know where things went, they just put in images of elephants. And as much as that might be a 300-year-old poetry, it is remarkable how much the story of Africa remains in many places the same, that Africa is treated as a place with very, very shallow knowledge and information pools. The parody is captured, you'll be familiar with a television show, Who Wants to Be a Millionaire? And it's captured in this parody where in the final round, to win not $1 million, but rather to win the prize of being able to go to Africa as a volunteer and save Africa from itself, this volunteer is presented with these 4 options. How many countries are there in Africa? 1, 2, 5, or 54? And she's awarded the $1 million because she chooses, according to the audience, the correct answer, which is 1. Africa is a place. And of course, it could hardly be more further from the truth. So a game that I play with my business school students, and I know on this call I've got some business school friends and colleagues like Frank Aswani. They've seen me play this game before. I ask my business school students, who are overwhelmingly African executives and managers, I ask them to to play a game. Name countries, number how many African countries there are, pick out a particular country. Can you tell me who that country is, what the capital is, and so on. And it will strike you immediately that people are unsure of how many countries there are in Africa. 54, 55, or 56, depending on who you ask. The specific game that I play has these couple of questions. How many countries make up Africa? Where is Guinea? What is the biggest country by land area? Can you name it? Can you name the capital, the country and the capital? Which country is this, if you can follow my mouse? And how many countries speak Spanish as the official language? Everyone knows that there is Anglophone, Francophone, and Lusophone Africa, but not many people know that there is one Spanish-speaking African country. So, how many countries make up Africa? The United Nations say 54, but if you recognize Western Sahara and Somaliland, you get to 56. Where is Guinea? Well, there are actually 3 Guineas. There's Equatorial Guinea, Guinea-Bissau, and just Guinea itself. And they are widely different countries, from $700 per person to actually middle income status in the case of Equatorial Guinea. Biggest country by land area is Algeria. The country that I flag is the youngest country in the world. It's South Sudan, capital is Juba. And when it achieved independence, it had 200 kilometers of tarred road across the entire breadth of the country. And then just one country is Spanish speaking. I gave that away already, and it happens to be one of the Guineas. So very often, when people talk about Africa, it's about Africa as a place, and the imperative to get off the dance floor and onto the balcony is a common call to management, that we get so caught up in the detail that we lose sight of the big picture. And I'm going to argue the exact opposite way around here from Marty Linsky's famous paper, or Harvard Business School paper. And I'm going to argue that in the case of Africa, we need to get off the balcony and onto the dance floor to work out just what's going on. And by way of example, well, some of you will have been watching the horrific news going on in South Africa. As we speak, there is widespread civil unrest, social violence, looting going on as a consequence, or partly as a consequence, of the incarceration of the former head of state, Jacob Zuma, for refusing to appear in court and repeatedly refusing the instruction to appear at a commission of inquiry. And so South Africa has descended in the last couple of days into tragic social violence, looting, and unrest. There is nothing that should surprise us about this. South Africa has been in an increasingly distressed place over the last decade or more, and it's captured in many numbers and metrics, including youth unemployment, broad-based unemployment, female disengagement from the workforce, grossly skewed balance sheets, highly concentrated industries, and a business environment that has become increasingly difficult. If we rewind to 2008, South Africa ranked 32nd in the world for ease of doing business. Quite remarkable for an African country. It now ranks 84th. There was no score done in 2020. By contrast, Rwanda, which in 1994 emerges from its horrific genocide, has gone from 143rd in the world in ease of doing business to 38th in the world over the same period. So Africa is not a place. And to speak to the mandate that Susan invited me to present on, could I talk about a continent of 54, 55, 56 countries in 10 minutes? Absolutely impossible. But I'll square up to the challenge in the final few minutes. and perhaps give you some of my street cred that I work for a family office. Over my 25 years of working in public markets and more recently private markets, and most recently venture capital, I've had the fortune of investing Pan-African. So we've owned assets in Senegal, Nigeria, Ghana, Zambia, Zimbabwe, Kenya, to name a few of the markets that we've been invested in. And our point of departure in thinking about investing is not what's the upside, but what is the context and what is the risk. If you've got risk wrong, it doesn't matter what you think the upside is, risk will eat your lunch. So our approach to investing is first to try and get a bearing on country context, and then to use that bearing of country context to turn that into information, intelligence, insight about asset classes and specific assets. I'm going to share in this short time 4 models that we use to think about this, and it's impossible for me to spend much time with any of these models, quite literally a minute per lens. The first model is what we call our 6-factor model. This is a piece of work I've been involved in the last 15 years or so in my business school capacity, where we used big data to identify 6 factors that correspond with countries that transition and transform to achieve elevated, inclusive social, economic welfare and progress. These are the 6 factors. They, I think, are self-evident and speak for themselves. Each of them needs to be qualified carefully. So, savings, funds, investment, and investment is not just investment for the sake of it. It needs to be gross domestic fixed investment with impact and inclusion that bolsters country competitiveness. A question was asked just before this presentation about demography. I think that this question is absolutely spot on. Demography is a very valuable ingredient. If harnessed, you need more people coming into the workforce than going into retirement, but it needs to be harnessed or coupled with education and healthcare. Policies need to be stable and institutions need to be capable, and then no country has got rich by building a wall or barriers and boundaries. So those are the 6 factors, and we map them across countries. We weight them and we sequence them, and then we use that weighting and sequencing to assess the growth prospects for 160 countries. This is the world map, and the center spot here is average world economic growth, where the world obviously scores on average somewhere in the middle of what we call the 6-pack or the 6-factor model. And it translates into what we anticipate for the world economy is in the order of 3% economic growth per annum over the current decade. And then we can go and pick out different African markets or other markets. So we can find nested in here Argentina, clustered down the bottom left are a number of African economies that are really struggling. Eswatini, better known as Swaziland, South Sudan, Somalia, Zimbabwe. But as you migrate westwards, eastwards and upwards, you will find other African markets. So for instance, Morocco, Algeria, Zambia, Uganda, Rwanda suggest far stronger, sustainable, and certainly competitive and inclusive growth. The second model that we use is CAGE, which speaks to culture, administration, geography, and economics. It runs the risk of being provocative in talking about culture, but culture is not right or wrong. Culture is simply our ability to connect and understand each other using cultural distance. And with that model of 4 factors, we can identify the similarity or distance between countries, keeping in mind that CAGE is always seen from the perspective of the principal. So that if you looked at this from a French lens, or the lens of France, or the lens of Switzerland, or the lens of Argentina, you would arrive at different conclusions. So we are looking for CAGE distance from our particular vantage point. And then alongside CAGE, we put up specific political and social risks. And those points couldn't be better made in South Africa's current circumstance, where the political risk in South Africa is high and the social fabric is very, very stretched. In a sentence, if you don't have a country, you don't have a company, or your investment has just gone out the window. This naively heat maps it, and adopting a South African lens, it then assumes if I'm a South African investment firm, I might find it most obvious or easy or practical to work in Botswana, Ghana, Rwanda, South Africa itself, Tanzania, Ethiopia, and I'm going to find it much harder to do business in, for instance, Angola. And recently, we've been involved in a big project with a listed multinational corporation, which lost a little more than $100 million in the DRC, where our primary argument was they got this CAGE factor wrong, imagining that they could find their way into that market with existing product, but when they arrive in that market, there is a substantial, not necessarily disconnect, but disorientation. The third lens is about currency and the ability to get capital into the country and out of the country. We have a range of ways of thinking about ability to get in and out. And in and out is not just to apply the capital once you're in the country, but to repatriate dividends, profits, and when you eventually realize your investment, to exit onto capital markets or to a third party. And this is just the case of Kenya, where we've applied those 9 factors to thinking about access of capital to the Kenyan market. And a final model that we use in thinking about or analyzing and assessing African markets is nowcasting, for the simple reason that access to data in many African markets is thin, it's often dated, it's behind the curve, that when it actually arrives and becomes a public domain, it's actually so far in the rearview mirror that it is irrelevant. If you don't believe me on that, go and try and find some information on Burkina Faso's most recent economic growth. And you will find that there are massive data gaps. So we use nowcasting, where we have access to transactions data, mobile data, and mobility data to confirm our information, insights, understanding of particular markets. This is a proprietary tool that we've built. The horizontal axis is our tool. The vertical axis is real-time economic growth, and it doesn't map one-to-one. The correspondence is 0.6, but it suggests that we have the capacity in real time to get a sense of how an economy is doing with about 60%, 0.59, 60% explanatory power. And then, Susan, if I can, with 2 more minutes, just talk to particular markets where I think that there are some interesting things to note in passing. So once we've lifted the lid on an economy, then the job is to dive into the economic and industrial structure. And here's the case of a number of different markets. This is Ethiopia. When you straw poll people and ask them what's the fastest growing economy in the world over the last 20 years, they'll tell you it's China. It actually isn't, it's Ethiopia, with a 100 million population and a construction sector that over 10 years has grown at 22% per annum. There is extraordinary construction, engineering, building activity going on. And just as Africa is not a place, no country is a place. And you will be alive and sensitive to the political and social challenges that are going on in Ethiopia right now. When we score the country against our 6-factor model, the suggestion is that Ethiopia has the structure of 6% economic growth, underpinned by very elevated savings investment rates. The second market that I think is particularly interesting is Ghana. And Ghana is better known for mining and quarrying, in particular gold. But Ghana has built in recent times a small but fast-growing and increasingly impressive ICT cluster, which has sustained growth of 25% per annum over 10 years. Yes, it makes up a very small part of the economy, but it is fast-growing and achieving regional competitiveness. In the case of Kenya, this is a small market, but has achieved regional strength and is establishing itself as an increasingly integrated services supplier. So, for instance, wholesale, retail, trade growing at 6% per annum. Of course, this is one of the bigger markets in the region. Nigeria is the regional giant in terms of population and ranks amongst the top couple of largest economies in Africa. It is typically spoken about as an oil economy. What isn't appreciated about Nigeria is that 1/4 of GDP is made up by agriculture. And there are some intriguing investment businesses and opportunities in that cluster. And then an unsung hero or underappreciated market in the region is Tanzania, a sizable population. It has a structure that supports 5 and 6% economic growth, a construction sector that has sustained 10% growth per annum, and points to what we think are some really viable investment opportunities. So, a reminder then in my last breath that these models, none of them have the answer on a particular market. Each of them is a lens or a perspective. The task is to then use that context to delve into markets and get the granularity, the nuances, the risk, the detail, the substance, and to turn that ultimately into investment ideas. When those investment ideas materialize, they can translate into substantial success. This is part of a project for a Pan-African aggregates business that we worked on to identify the drivers of their product and market gaps where they might be missing opportunities. And this was a project for a consulting business, which at the moment has a relatively modest African presence. And we think that there is a substantial growth prospect for them in a small set of identified markets, which is why I listed those economies in that last run. For instance, we think Ethiopia could give birth to a market of $150 million for their services business. And if clustered with other African partners, it could translate into something like a $500 million market for their services. So Susan, that's my 10 and a tiny bit minutes, and I made my 39 slides. Thank you.
Thank you very much, Adrian. That was really interesting. If there is any way that we could, or that you could share that presentation with us, that would be fantastic. Sure. I've had quite a lot of feedback on the chat about that very point, but thank you for that. Now we're on to the business environment with Philip Thigo, who is the Senior Director for Africa at Thunderbird School of Business Management and also an advisor to certain African governments. Philip, over to you.
Zoom etiquette, my apologies. Thank you so much, Susan, of course, Luke, Mark, for giving us this opportunity to have this important conversation on Africa. So I wear 1,000 hats. I probably need to get another to sort of shed a couple of day jobs. I think I want to focus basically, of course, to build off Adrian's presentation is simply how the continent is misunderstood. So I want to focus on how we are organized. Interesting about Africa and the opportunities for investment is we are highly organized around development goals. So we are highly organized around how to solve challenges and not necessarily around, we are not trying to go to Mars or have self-driving cars. We're trying to see how we can leverage on the best potentials to fix problems of healthcare, health system innovation, workforce recovery, labor. We have our own agenda. We have our own 50-year agenda, probably the only continent that has it. And potentially in responding to crises, we are potentially the only continent that moves at the continental level where, as we speak right now, the president of South Africa has been mandated to convene a COVID-19 commission. I am part of this whole work that we are looking at how Africa CDC, which is only 4 years old, again, a very young continent, can actually help deliver vaccines at the moment where we've only vaccinated about 2% of the African population, which creates a business opportunity around health investments. I think the current moment in time, we stand at a critical juncture. And so not necessarily looking at the narrative of a dark continent or continent as one place, but thinking about what are these opportunities? So for example, we have about 420 million youth in Africa. The median age is actually 19.1. So we are the youngest continent in the world. My country, Kenya, we are 19.7. Niger, median age is about 14. So you can imagine what that means or portends. It can either go either way, either demographic dividend or a potential time bomb if not harnessed properly. Of course, we are still fastest growing. We are highly entrepreneurial, but then we have a discontinuation rate of 14%. We are highly SMEs or MSMEs driven. 85% of our economy is informal, 15% is formal. Potentially because of COVID-19, maybe there will be a shift in terms of more informal and less formal. There's really a slow rate of structural reforms, though we still have the 10 fastest growing economies. The other pieces, I don't think we are fourth industrial revolution ready. We're just not necessarily ready for the emerging technologies. But I think we are seeing flashes where, because of not having legacy infrastructure, infrastructure, which includes whether it's physical infrastructure or laws and policies, then there's a lot of opportunity to innovate, do sandboxes and leapfrog towards a sort of a new economy that is not necessarily linear. As I said, so we have, so these are the countries. So it was interesting when I was looking at Adrian's presentation to see whether these countries fall in his bracket. So maybe this is something we can look at in future, but these are the fastest growing economies as of 2020 globally. So there's actually a promise. And the good thing is that it's spread across all the 5 corners of the continent. The population is 1.3 billion, projected to about 1.7. So that speaks to a larger market. The good thing is that 80% of these will be in cities. So which means we are the fastest urbanizing continent in the world. We're also seeing, because of new technology, but also just a manufacturing revolution, the continent is going into manufacturing and production. New areas that were not there before, there's processed food, semiconductors to mobile phones. We are seeing also co-location of whether it's vehicle manufacturing. We're seeing VW in Rwanda. Of course, there was already something in South Africa. We are seeing also them moving to Kenya and increasing around the continent. So there's that manufacturing engine moving. Of course, it's because of the skilled kind of capabilities that we're seeing over time because of simply improvements around education. We are seeing also infrastructure because this is really the engine of any economy. This has doubled over the last 10 years and it's about 80 billion. So we think there's a lot of opportunity for this. And when I say infrastructure, looking at roads, bridges, rail, I mean, Kenya only added a meter of rail since 2000, since the year 1901 in 2015. That's the only time Kenya literally added a meter of rail. since those years of the British colonialism. But now we are seeing a lot of investments around closing the infrastructure gap. I think in terms of innovation, as much as the continent is not ready, the young people are. And so we are seeing a lot of innovations across the continent. People say COVID-19 did not necessarily hit Africa the most. We think there was a lot of innovation capacity unleashed. It's the only continent that we saw, for example, a Brachial Foundation from South Africa working with Facebook to build, whether it's contact tracing apps or mass public campaign engagement around COVID-19, wear masks, social distancing, and all that. We also saw how a lot of African continents worked on differentiated lockdowns based on technology innovation, even though their data systems were very weak. So we saw how, and there lies in again the potential for business, where in Africa is really about solving problems. And believe me, we have a lot of problems which we call wicked problems. This is always the elephant in the room. Africa has been plagued by a lot of governance challenges. Yes, we've seen the photos around coups. I think coups are really far and wide, and this is because of the African Union. They have a principle of non-indifference that is preferred now to the one of non-interference, where no African government, no military can just stage a coup without interference from either regional economic blocs or the African Union, because we have a standby force that is always activated when peaceful means fail. But I think also because of the African Union, we are also seeing, yes, a couple of heads of state becoming a little bit, innovative in terms of extending their presidential terms through constitutional means. But I know that's been addressed in a way that people do not extend their constitutional mandates. We are seeing an improved civic and fiscal space, but also judicial independence, which means businesses can actually have their cases arbitrated in court. And this is an increasing phenomenon. We're also seeing countries adopting interesting new norms of open government, especially those that look at transparency, accountability, that focus on public service delivery, open contracting, beneficial ownership, and a lot of collaborations in terms of countering violence extremism, but also just sort of illicit financial flows that are happening either between countries. And we're seeing either bilateral agreements or normative agreements that are being signed by countries. And then this is something that I wanted to mention. The continent population is largely female. We're the only continent or region in the world that women are more entrepreneurs than men. In 3 countries, Uganda, Ghana, and Botswana, where women own more businesses than men. So there's now a lot of investment, whether it's from the G7 or whether it's G20 or whether it's the African Development Bank or Bill and Melinda Gates, focusing on how do we ensure that we can invest in women entrepreneurs. Finally, I think for me, this is our jewel or crown jewel, as we say, in the continent. We now have the largest free trade area in the world. We don't know why it took this long, but this is now in effect. The pact connects about 1.3 billion people across the 55 countries, and again with a combined domestic gross product of 3.4 million. The good thing is that when we're having this webinar, this is still early stage. There are still a lot of negotiations around whether it's rule of origin and all of those. So this is a good time to actually begin to look at Africa as, yes, not a place, not a country, but as a one trade area. So that's the new normal. We think in terms of doing business, the future is digital. Simply because we know there's a lot of data gaps, as Adrian has mentioned, and you cannot invest without data. So how do we ensure that if you're going to do business in Africa, then we think these are the biggest areas. If it's data, because of artificial intelligence and what that portends, there's enough business around data. Issues of energy, we know there's investments in green, clean, a lot of opportunities around the sun. We have one of the largest deserts in the world. Internet, because our internet connectivity is not so much coverage, yet we are still highly connecting. Last year, we had almost a 30-40% leap in connectivity because a lot of our communities, because they are young, are highly mobile. There's an opportunity for capacity development, especially around skilling and upskilling. The population is young. And then there's a capability around agile governance. So how do you ensure that you can actually create new norms and standards that you can govern business and trade in a way that is not necessarily a prerogative of government, but then creates a multi-stakeholder environment and ecosystem. And we're seeing that being tested across countries. This is just the internet growth by region, and you can see why this is important. I think, yeah, so I think finally for me, that ends my presentation. Thank you.
Thank you very much, Philip. It's good to have you say that the future is digital, because I think Africa desperately needs that now. Because the red tape is pretty endless in many of these countries. Thank you very much. Next, can we please hear from Sami? And Sami is the director of, one of the directors of agriculture at CDC Group, which is not the CDC Group in America, but is the UK Development Organization. Thank you very much, Sami Khan. Thank you.
Thank you very much, Susan. Good afternoon and good morning to everybody. It's indeed an honor to be present at this event. I'm not sure if you can all see my screen.
Yes, perfectly.
Excellent. So as Susan mentioned, I'm with the CDC Group, and some of you may be familiar with us, but those who are not familiar, CDC Group is a development financial institution fully owned by the UK government. We have a 70-year history of investing in Africa and helping to make a transformative change in a number of sectors. We are recognized as the oldest development financial institution in the world and the oldest impact investor in the world. We have made over 1,200 investments in emerging markets. Moving on to the next slide, in the context of Africa, as we all know, there are a number of structural and systemic issues that are holding back the development of a number of industries and a number of sectors across Africa. Our experiences and learnings over 7 decades of investing in multiple sectors have taught us many lessons, but one of the most important lessons that we have learned is that the achievement of sustainable development impact and commercial objectives requires a flexible and patient capital approach with a long-term view and a higher risk appetite. So therefore, there is a need for what we call catalytic capital or catalyst capital. It goes without saying that the investment statistics speak volumes about the dearth of capital coming into Africa. Of the estimated global 7.4 trillion in private capital investments, it's estimated that less than 2% are in Africa. And we would all agree that those figures are kind of an injustice, given that almost 20% of the global population resides across the continent. Furthermore, FDI inflows to Africa are estimated to have dropped by around 30 to 40% in 2020 alone, on the back of an earlier already year-on-year decline in 2019 by 10% to 45 billion, which just represents just about 3% of global FDI inflows that year. What is, in our view, what we think is what is required is a need for a holistic approach to unlocking the intrinsic inherent potential growth opportunities in African agribusiness or businesses in general. The desired architecture for transformational change in Africa over the long term would in a way require a 3-pronged approach. One is, of course, institutional support, and there we're talking about strengthening both public and market institutions. 2 is incentivizing the private sector to participate more. And more importantly, for the discussion of today on my subject, a fundamental change in the approach to the provision of capital to the continent. On this very point, we as CDC Group have developed a new approach to the provision of capital, which we, in special situations, specifically in emerging markets like Africa, call catalyst capital or catalytic capital, which we invest through our catalyst strategies to shape nascent markets and build more inclusive and sustainable economies. It's an innovative approach to impact that we are developing to build on our 70+ year history of investing in emerging markets. Given that we are investing in markets where there are few precedents or benchmarks, we take a flexible approach to risk in exchange for pioneering impact. Our rigor, more importantly, is relating catalysts is anchored not around target returns, but around risks. We have 2 strategies governing the deployment of catalyst capital. First is through our generalist catalyst strategies, which basically explores a broad range of investments with a view to addressing persistent market failures. And we're talking about here enhancing inclusion, promoting innovation, or reaching deeper into frontier markets. And this is undertaken by two generalist sub-strategies called the Accelerator, which allows us to basically try out new models or establish a proof of concept through our direct investments. And secondly, via our Catalyst funds, which allows us to take a sort of a intermediate approach through our funds. The second strategy regarding deployment of Catalyst capital is thematic, and this is done to address specific needs of subsectors. For instance, towards closing of value chain gaps in the food and agriculture sector, of financial inclusion and sustainability. Our parent, the FCDO, or known as the Foreign Commonwealth Development Office of the UK government, has awarded CDC access to a pool of catalytic capital, which gives us more flexibility on risk in pursuit of enhanced development impact. As part of the governance of this capital, FCDO has set qualifying criteria. And to address these criteria, CDC has developed principles that describe how we aim to use catalytic capital and the markers by which we would judge success of the portfolio. Essentially, Catalyst capital enables us to have a more flexible risk appetite in exchange for enhanced development impact over the longer term. Moving on to the next slide. So what are the underlying principles for Catalyst capital? CDC's investments seek to have a positive impact on people and the planet. Every investment and strategy should try to address the either a socioeconomic or environmental challenge issue that assumes that in the case of Catalyst, we set a higher bar versus our normal ordinary growth capital. The impact thesis of every Catalyst strategy investment must make the case of how the transaction meets the ultimate impact hurdle. And for that, we set that out in the Catalyst impact framework. And in this case, you'll see here is very specifically related to inclusion and climate action and environmental sustainability. People and planet are often our courses, often inextricably linked, but for simplicity, we've tried to present it in the manner as you see in this slide. In terms of understanding the pathways, the impact pathways for Catalyst capital, we start off with the basic premise that for the impact framework for Catalyst capital to be anchored on contribution or additionality that we provide through catalytic capital with a flexible risk return profile that will help to gradually mobilize capital and with the notion of adding value beyond capital alone. And then we have the desired impact, which is achieved through two routes. One is scaling up businesses, and the second is in catalyzing markets. And finally, as we saw in the earlier slide, we define the ultimate end impact we want to achieve on inclusion and climate action and environmental sustainability. The types of transactions and market failures we want to address require more flexible risk appetite because of the following factors. One is high uncertainties, which may stem from a number of external factors, such as innovation or risk perception. On first mover disadvantages that burden first movers with costs that followers do not bear. And then, of course, we have higher structural costs, such as those from collective action problems requiring coordinated investment across multiple actors before we reach economies of scale. Beyond the direct impact of scaling up businesses, Catalyst investments may also allow us to catalyze markets by addressing systemic barriers that will make markets more efficient by being more integrated across the value chain, competitive and or resilient. And catalyzing markets from CDC's perspective requires a strategic portfolio approach with a cluster of investments, market building grants, or technical assistance facilities. We have an internal tool called CDC Plus, where we do provide both grant capital for technical assistance as well as advisory services. Catalyst strategies invest where we can see a path to commercial sustainability over time, and that if successful could attract third-party capital to replace CDC's Catalyst capital in their longer term. So what are the markers of success for our catalyst strategies? One is, of course, financial performance. And secondly, very importantly, development impact. And of course, we track the evolution by testing new impact thesis and developing a portfolio around it. We also look to for a graduation of company from a CDC catalyst investment to CDC's growth portfolio. And on the issue of mobilization, the idea is to attract third-party capital and learn from both success stories as well as less positive outcomes. On one final point before I end, it would be helpful to further define what we mean by higher risk. Our rigor around catalysts is anchored not just around target returns, but around risk, as I mentioned earlier. And Catalyst was designed to apply a high risk appetite compared to growth investments. And whilst the probability of loss is greater in all of the Catalyst investment profiles, the expected return remains positive. This is quite an important point because it illustrates that on a deal-to-deal level, we still expect a positive return, but apply a higher risk appetite. And finally, in terms of how does this look on the risk return continuum, growth capital versus catalyst capital, unlike the growth portfolio where investments are made in commercial entities with a lower risk profile, catalyst allows us to look into sub-commercial type investments where we will still derive positive absolute returns over the long term with capital preservation, but with a higher risk profile and deeper expected market impact. I would like to end on this note, and thanks again for your time.
Thank you very much, Sami. That was very interesting, especially because Africa so requires that catalyst capital and frankly cannot rely solely on investment proceeds and private pools of money. But I'm going to be speaking about that in more detail later. Thank you very much. And we would welcome our next speaker, which is Frank Aswani, who apparently, Frank, you know Adrian from previous experience. But
yeah,
that's quite interesting. Yeah, please go ahead.
Yeah, it's great to see Adrian here. Adrian actually was my professor in my MBA class.
That's
so
nice.
I must represent him well today. But thank you, everyone, for giving us a chance to talk about this. And it's fortuitously, I think the sequence of speakers has been phenomenal in setting up what I'm about to talk about. And I'm going to talk about a bit about philanthropy, but not philanthropy in the context of how we've always viewed philanthropy, but philanthropy in the context of the role and the critical role that it could play in helping Africa move forward and especially meet its SDG goals for 2030. Now, the continent needs between $500 million to $1.2 trillion annually between now and 2030 to meet the SDG goals. And currently, that funding comes mainly from aid, FDI, and a bit of government funding. But you will all know that aid to Africa has been on the decline. The UK government has reduced its aid budget from 0.5 to 0.7 of gross national product. The US government in Trump's era reduced USAID funding to Africa. And in some cases, actually, some of the reduction in aid has come out of a crisis of success, where the more African countries move into middle income status, they become less deserving of aid. But also we're seeing that from the AIDS donor countries, more and more of them are moving from aid to trade or aid to impact. So things are changing, and we've got to transition and change differently as we go along. But the continent sadly is not ready for that transition. We're not geared and set up to change how we'll mobilize capital for social investments. And in the context of all of this, we can only potentially raise about half of what you need from government funding, FDI, and current aid inflows. So where are we going to get the rest of the money from? So the private sector becomes our most obvious place for us to go look for money. And that is where, to Sami's point, we need to also think about the role of philanthropy as a catalytic in crowding in private capital into social investments. How do we use philanthropy not just for the typical philanthropic investments that are required, but also to de-risk social investments? And how is it that we can go about also changing the mindset of our grant makers on the continent, which includes government and some of the aid agencies, to utilize the capital differently, to especially crowd in local private capital? And that is something I think the continent has to learn for us to move forward. We'll not move Africa forward without embracing private capital. We don't have enough money in the social sector as we speak. But that means we've got to build local capacity in especially innovative finance. And one of the things that we are struggling on the continent is we have our social investors on the continent and our governments are still thinking in a very traditional sense, where we first of all have to wean ourselves of aid and grant money, but also start thinking differently about how we leverage that grant capital to crowd in private capital. You will see from things like the C3 consortium in the US and how they've mobilized capital for India to fund mini grids. We need to build something very similar on the continent. And this is where the innovation comes in. But sadly, from a capacity building perspective, the whole continent of Africa has only one institution of learning with an innovative financing program. If you want to do innovative finance in Africa, to learn about impact investing, how to blend capital, how to use things like outcome-based financing, results-based financing, you have one choice of an institution. Others, you've got to go to Oxford, Cambridge, Duke, or Stanford. We can't build a continent like that. We'll never get Africa from where it is to where it needs to be if we don't build institutional capacity. And on that end, we're trying to do a couple of different things, and I'll share with you one or two things. But I think from an impact perspective, if you're an impact player on the continent and you're truly committed to global impact, you've got to be in Africa. As Thigo said, Africa is a sandbox of innovation. We have so many problems, and in every problem is an entrepreneurial opportunity. If you're thinking about creating impact, this is where you need to come. If you look at some of the innovations that have come from Africa, from M-Pesa to Zipline, where they're using drones to transport blood, the legislation in Africa is at a point where it follows innovation. If you want to develop innovation that will have global impact, there's no better place to be than to be in Africa. So I strongly believe that you have a really good opportunity as a philanthropist today to think about how you can apply your money catalytically and innovatively on the continent to solve global problems, not just African problems. So as an organization, we have committed to doing a couple of things, and we want to see how we can help the continent and people coming to invest in Africa do a couple of different things better. So I'm going to share my screen and share with you some of the things we're putting out. So AVPA, as we are an investor-only community. We bring together people deploying grants, debt, or equity into the impact space, because we believe it's a blending of those different types of competencies and capital that will give us the ability to crowd in the right amount of capital for this space. So we also embrace the significant role of non-financial capital providers in the social impact space. So one of the things we do is a deal share platform. Now, this is designed to make it easy for a couple of investors. If you're an investor coming to Africa and you're looking for social investments, because we're always being told that there's more capital in Africa than there are investable deals, we're going to solve that problem for you. We have curated the platform that brings together investors and deals. And because we're an investor-only platform, all the deals on this platform have to be listed by an existing investor in the deal. So investees cannot list themselves. They have to be listed here by an existing investor in the deal. So you'll see, for example, in the green boxes at the bottom here, Samata Capital is an investor, and Nature's Bounty is a business. And we bring on board here people of all sorts. And you can filter on this platform different types of business that may interest you, different types of financial instruments that you may wish to use, from convertible instruments, debt, equity, grant. We cover all the 54 African countries. We cover all the 17 SDGs, and you can go on and on across the platform. And on the platform, we have a variety of social investors, from aid agencies, impact investors, foundations, to PE funds. You'll see the Italian aid agencies here. So you'll be able to interact with a wide variety of investors on the platform and co-invest in really impactful opportunities on the continent. So that's the first opportunity we can help give you to make it easy for you to invest on the continent. The second thing is data, and Adrian mentioned the fact that getting real-time data in Africa is hard. So we last year, towards the end of the year, and we launched this study in November. And Ariel from Intellecap, who's part of the audience today, were the people who helped us with this study. We mapped out the social investors on the continent, for anything from angel investors through PE funds, impact funds, to governments, and we produced 3 reports that can give you the scope and status of the investments in Africa. Thankfully and grateful to the sponsorship of USAID, Rockefeller, and Social Capital Foundation. So you're able to get 3 regional reports and 1 Pan-African report. And if you want, at the bottom, You can go and get some additional data, which is barely 6 or 7 months old, looking at key social sectors, what are some of the regulations and stuff. And we intend to roll this and repeat the study every 2 to 3 years to make sure that we're updating the content in here as much as possible. One of the things that came out of the study was the significant role of gender. When people look at gender in Africa, they look at it as a thing you do after you've done everything else. But there's huge opportunities in gender. If we get gender equality right between now and 2025, we can add 10% of GDP to the African GDP. $360 billion lies in us just getting the gender equality right on the continent. And so we have a gender platform that aggregates people playing in the gender space. And we're focusing especially on the gender lens investment space, bringing together players, investors who have a focus on gender. And if you go down here, you'll see all the people who are part of this. We're very lucky to have foundations from Europe, banks in Africa, a lot of funds in Africa. That's stuff that we can do to serve you as well. On our events page, you'll be able to find everything that we're doing to support various types of investors on the continent. We work with Looney on the Angel Accelerator program. We're doing development impact bonds. There's a really cool stuff we've done. We'll be showcased here on sexual health development bond done in Kenya. So there's room for innovation. And we can help you build some of that innovation and engage Africans. Most importantly, help Africans get better at mobilizing capital for their own investments. And lastly, one of the things we're super excited about is in trying to build local capacity, we've just launched the registration for an Asia-Africa Impact Investment Fellowship Program, which we're doing with the faculty from Oxford Side Business School and our sister network in Asia. And this is part of strengthening South-to-South collaboration, because we believe there's a lot of lessons that Africa can learn from Asia and teach Asia as well. And in the process, we believe we can accelerate Africa's learning. So this is open to fellows from Africa and Asia. The application process is open at the moment. And this is the beginning of the things we'll be doing to improve investment, innovative finance capacity of the continent. The big one that I'm really working on right now is to try and bring together 30 or 40 African universities and an umbrella association, and have the likes of then Oxford, Cambridge, Duke, and Stanford, who are all sitting under a consortium called Impact and Sustainable Financing Faculty Consortium, come and train the trainer programs with our universities. So in about a year or so time, we can have these 30 or 40 being able to build their own, to run their own institutions or departments of innovative finance in country. So Susan, thank you so much for the time, and I hope we're here to help anyone who's looking to invest in Africa. Thank you.
Thank you. Thank you very much, Frank. Can you just mention which is the university that you referred to as being the one that teaches innovative financing in Africa?
University of Cape Town, the Barthas Center at University of Cape Town. It's the only one in Africa that has an innovative financing program. Okay,
well, thank you very much.
Yeah.
So I think that I am now the next speaker about one of the first two speakers about African agriculture. And I will give an overview of the African agricultural environment from an owner and operator's perspective. But welcome all of you to the agricultural segment. My name is Susan Payne. I'm the Chief Executive of Holistic Agricultural Investments Group. We're an African-based company that co-owns, operates, and advises on large agricultural ventures on the continent. Over the next 10 minutes, what I'd like to cover is why I like African ag as an investment destination, why I regard it as so vital to Africa on so many levels. And actually what I'm going to say ties together many of the comments that we've heard already today. Put simply, how I view African ag is it's a workhorse. It covers multiple human necessities. It covers business interests. It covers countless business strings. In Africa, it addresses food security and undernourishment, joblessness, poverty, inequality. At its best, it involves green initiatives addressing climate change and includes multiple spin-off businesses along the supply chain, from growing to processing, marketing and distributing food, as well as trading commodities and carbon credits. It involves land improvement, infrastructure development, creating water delivery systems and roads, as well as housing and facilities for project staff. And this is a continent where only 43% of all roads are paved, and 30% of those roads that are paved are in South Africa. So this is the picture, and this is the background of what we're talking about. Agriculture in emerging markets in particular catalyzes multiple productive, profitable, and impactful ventures. What I'd like to begin by examining is why African ag, why is agriculture and its development so crucial for this continent, and how Africa can accelerate its food output sizably, uplifting whole regions and creating jobs, and what the biggest challenges are, how governments, banks, and development agencies and other actors can best support this community, giving the sector every chance to flourish. I'll also present a brief outline of a couple of our projects as examples of what SMEs can deliver in the food space, and to show why I left the city in London to put my money where my mouth is, effectively. First, why consider agriculture? Well, in Africa, agriculture accounts for the livelihoods of about 55% of the workforce, and its success and development is imperative for a number of reasons, but it struggles. So why do we care? Well, just consider the fact that Africa imports $40 billion per annum in food crops, and this is estimated to increase to 110 billion per annum within 5 years. It's a continent that has substantial and continuing food demand. Also, it has a very young population, as we've heard earlier today. The average age is under 20 years old, compared with 38 years old in the States, 40 in the UK, and 48 in Japan. It's dynamic, it's hungry for opportunity. While Africa's youth is its greatest resource, though, these millions need to find jobs, making the biggest challenge for African governments job creation. So how can Africa accelerate its output and solve the problem of food security and job creation? Most African countries have all, or most have, natural resources that could solve the problem of food security quite easily and job creation. Aside from Africa representing 65% of the landmass globally, with 20 substantial rivers, this continent has substantial competitive advantages, and it's these competitive advantages that really do matter here. Fertile soils, long light hours, strong heat units, year-round cropping, huge water resources, ample space in which to develop an agricultural ecosystem, and hubs where both farming and processing can flourish. Another advantage is Africa's millions of smallholders. According to McKinsey, a whopping 80% of African farms are under 2 hectares, compared with only 6% in Brazil. But smallholders can be consolidated with structured support to increase productivity and wealth on a far wider basis. Finally, Africa offers a strong entrepreneurial spirit, with the continent having more entrepreneurs per capita than any continent, as Philip said earlier, and more women entrepreneurs than men. Necessity is indeed the mother of invention here. There are operators like Holistic, like my company, and many others, including countless displaced Zimbabweans and South Africans, that are prepared to buy and operate farm sites, hiring and training hundreds of workers who can then start their own farms. This gives participants a blank canvas across the agri-chain to create their own outcomes in an environment that offers well above average returns for patient capital. But there are challenges, so let's look at the challenges. I categorize challenges into 2 groups: those that are difficult to change swiftly, and those ones that can be changed with action, awareness, and creation of partnerships. And partnerships, I think, are vital to the development of Africa. In the first group, the factual challenges are that African farm managers' average age is 60. It's older, it's in an industry which is not hugely appealing for young people. Agri is not based in an urban environment at a time when mega cities across Africa are attracting the youth. It's not yet high tech. There's often poor infrastructure. Climate can be uncertain. There's excessive red tape, and power shortages are not unusual. So I've just talked myself out of a job. But let's face it, the first step in growing crops is tough. But the rocket to power returns for investors in agriculture relies primarily on 2 boosters, and both are the main challenges here, really. Sufficient funding and operational management. Regardless of if you're looking at small or large projects, it's these 2 areas that are the biggest challenges to success. On funding, banks by and large do not like to lend to agricultural projects. Governments should encourage them and put in place affirmative action programs to do so, funding at preferential rates. And if governments want and need jobs to be created and food to be produced, then they should work in partnerships to take greater action on the ground than I have ever seen across Africa to date. Lending rates are prohibitive, funding is restrictive, and there's little evidence of development capital allocated to be directed through these banks into the small and medium-sized agri-companies that, if they were properly funded, would have the power to transform their economies. If Africa can attract investment into its SMEs, Whether in agriculture or any other sector, the continent can lift itself from financial dependency. If governments are innovative and focus on partnerships with supranationals, banks, local investors, and advisory groups, they can better mobilize their resources, technology, and people. This SME group, the missing middle, I call it, remain unsupported generally. Their demand for sub $10 million financing is seen as generally too low for DFIs in light of the due diligence required, yet too high for local banks to seriously consider. Yet SMEs make up 85% of food production in Africa. In South Africa, only 6% of SMEs receive government support and 9% private funding support. According to the IFC, this leaves $5 trillion in a financing gap for small to medium-sized firms, and that is not improving. The second challenge with agriculture is operational or execution risk. And we are very familiar with this because we operate large farm sites. Farming is outcome-oriented, and projects need strong on-the-ground capability that understand the cultural nuances and different operating environments between Africa's 54 countries. In my opinion, to achieve food security, competence at scale is needed. Nanofinance simply will not work on its own. There needs to be a purpose-led mandate executed by trusted, and I do not use this term lightly, trusted and experienced teams focused on sustainable, preferably green initiatives to harness bigger projects alongside the smallholders looking for markets and support, which these large farms provide. Other challenges are climate, which we know can be uncertain anywhere and need to be managed and insured against when possible. And a final main challenge is optical. Global markets tend to treat Africa as a homogeneously high-risk continent and don't acknowledge its economic and geopolitical diversity, nor the different levels of development within its countries. For example, Mozambique, one of the 10 poorest countries in Africa alongside Somalia, Madagascar, and Niger, shares a long border with South Africa, often called the Switzerland of Africa, and one of the top 3 richest countries on the continent after Nigeria and Egypt. I wanted to finish by outlining very briefly 3 of our projects in Africa, which we co-own and operate, 2 of which were purchased as dormant sites and a 3rd coming online now. They reflect the fact that companies can make it their goal to grow food holistically, increase food supplies for a growing population, focus on crops that sequester carbon, and introduce social programs. On the first 2 sites, we trialed several crops to find the best suited to the farms with the strongest local demand. On the Mozambican site we have of 3,000 acres, the answer was in bananas. Pull that up. I'm going to pull up a couple of slides here. Can you see that? Can you see that?
Yes, now.
Okay,
Yes,
okay,
we can.
thank you.
Yeah.
Thanks, okay, fine, thanks. Okay, this just gives you the backdrop. This is the environment that we're operating in Mozambique. Not that the entire region is like this, because there are some burgeoning towns near us, but this is the village that is directly beside our 3,000-acre farm. We basically bought out this farm in a dormant state, and we decided that the best way to, hold on, I'm trying to flip this. That's it. Thank you very much. That's good. We decided that the high value crop, which was going to be the most profitable for the region and also allowed high carbon sequestration because the trees are carbon guzzlers, is bananas. So we took 14 acres of tissue culture and grew it out over 3 years to 125 acres of very high yielding bananas. This is just the beginning of that. This is in fact after year 1. If you go back to the first one, you'll see that we took the seedlings in the bottom left, and if you go clockwise around the circle, they grew up in 1 year to be substantial trees and start to yield fruit. Then this is after year 1, this picture, and these are banana trees that are yielding 70 tons of bananas per 2.5 acres. This footprint is going to be trebled from 125 acres currently. Over the next 2 years, it will treble in size. We've trialed other crops at the farm like sugarcane and cotton, vegetables. We've trialed a series of different crops that are all high yielding and suited to the region. But bananas are, to my mind, the most reliable, strong income generators, and they sequester greenhouse gases, which is also very appealing to us. They're labor intensive, so they provide several hundred jobs, and they will provide several hundred jobs over the next few years. Right now, 56 jobs, but that will increase. And they've also helped to double the value of the project in the last 3 years alone. With income generation starting this year, that should increase quite sizably over the next decade, over the next 5 years, as a matter of fact. So if we just work down this, this is just an example of, we trial the crops, we then grow the crops out, we put in our asset security, we put in our guards, and then we build out the infrastructure and put in the gardens and build the housing, and then we do community projects. So this is quite direct, I would say direct impact agriculture. We take a group of Europeans down every year. We couldn't last year. This is a group of 10 students, and they help to build schools or repair schools. They teach in schools. They put in benches. They're actually putting windows and floors in a school on the left side here. We give out a lot of bras and shoes. It sounds perhaps slightly mad, but bras and trainers are in very big demand. So we give out quite a few bras and trainers, and we teach sports camps and put in boreholes. There's a borehole that's just gone in there. So I'll go into our second site. Our second site is in Zambia. It's just under 7,000 acres. It's recently secured a license as one of 6 farms to grow CBD hemp. And this has been, CBD hemp, you may or may not know, has been scientifically proven to absorb more CO2 per hectare than any forest or commercial crop, full stop. The hemp crop is a first for Zambia very early on in Africa, generally where only 8 countries allow it to grow. The site is currently growing wheat successfully, and this is the farm. It's got, you see the pivot circles are 1 kilometer each. We've got multiple circles. It's a sizable farm, and there's a compound in the middle of it. We grow wheat on the farm. We've grown other crops on the farm, peanuts, for example. That's the nut crop and the processing on the right-hand side. And we've trialed a number of tree crops in particular. We like tree crops, and there's a good chance we're now going to start to grow oranges, because that's another high-yielding tree crop that is quite forgiving. The house at this, the house is agritourism. I mean, you can use these agricultural buildings for agritourism as well. It's rented out regularly, and well, not regularly, but sometimes. And the view is over Zimbabwe. Basically, I'll go back to that just right. My point here is to show that there are many large crops that can be grown simultaneously on these farms and processed on farms that are well priced like our own. So we're probably quite typical, and we've grown under contract. We've grown many crops under contract for various different European and North American names. But Africa does have a strong competitive advantage when the pricing of labor for labor-intensive crops is compared against other markets, especially where there are good roads or a port or international airport nearby. Finally, we have a third project underway, which is an agri-tech business called Sustainable Planet, to grow and process plant protein at scale in Mozambique. We're in the final funding raise for that now, and we want to be an early mover in the plant protein business in sub-Saharan Africa. Sustainable Planet uses technology developed by a specialist European university and has the added benefit that we can grow the plant on non-arable land using high salinity water that doubles in volume every 24 hours and results in what I call a food hero, with a higher protein content than soybeans and absorbs CO2 emissions. This is then used for protein powder, vegetarian food, sports drinks, and even animal food. That's fine, we can take that down. That's great. I'll close by summarizing the key points that make African agri a generational opportunity. The first is demand on the doorstep. Food and water security are the priority as Africa's population of 1.2 billion expands. Food riots remain a regular occurrence in Africa, like last year in South Africa over food shortages caused by COVID, and in 2019 in East Africa due to drought. Humanitarian crises can easily be triggered by food insecurity and lack of employment. My second point is that the current ag model in Africa is failing. The continent is urbanizing at a fast clip while more and more ag projects are disused, distressed, dormant, and waiting for investors to buy in at low levels and to revive and expand them. To feed Africa's enormous demand and to leverage this opportunity, we need to see progress in various areas, though. First, leadership, to bring positive vision to life through thought leaders. Second, partnership, working with networks and institutions to provide maximum leverage to agriculture. One example is TAAT, T-A-A-T, Technologies for African Agricultural Transformation, that works with governments like Ethiopia, which had an annual wheat deficit, and with improved heat-tolerant seeds from TAAT is on course to become self-sufficient. Third, Africa needs technology to be promoted as the greatest accelerator of change to solve problems in growing, monitoring, cropping, and delivering food. Africa needs to control its supply chain. It cannot keep shifting its crops like cocoa and nuts overseas for others to create factories and jobs away from it. With only 1% of manufacturing in the ag sector today based in Africa, there's a whole layer of profitability and productivity being left on the table. Africa needs to build more agricultural industrial parks to connect agri-processing upstream and focus on clusters of ecosystems with various synergies. It needs its governments, development agencies, and investors to support SMEs and direct investments, not just funds. For example, 98% of Chinese businesses are SMEs, 40 million of them, and contribute 68% to its exports. Funding this missing middle is imperative in developing countries. Africa needs to support smallholders with access to funding and training, often given by the larger agricultural sites like ours. It needs to franchise the disenfranchised, creating critical mass and clusters of agri-ecosystems. Finally, Africa needs to better showcase its successes and investment opportunities in formats and in events just like this. This is vision in action. With continuing progress in these areas I've listed, Africa can become a global food engine. From one agricultural stone, many ripples are increasingly going to follow, creating diversified businesses, greater technology, special economic zones, and so forth. And what is currently a less crowded investment space will become far more crowded as Africans harness and capitalize on their God-given competitive advantages and ultimately leapfrog forward in the sector. Thank you very much. And now on to Richard Lackey, who is the chairman of the World Food Bank. Richard and I share many similar views on Africa, and I really look forward to hearing what you have to say, Richard.
Thank you, so kind. That was fantastic, Susan. So I have made a note not to follow you again. Yeah. That was terrific. I'm still trying to take notes on what you're doing, and instead of reading my own to prepare. But I'm delighted to be here. I'll give you a little bit of, there's an old saying of tell me where you sit before you tell me where you stand. My background is about 8 years in emergency medicine, about 25 years in asset management, running hedge funds, primarily focused in international real estate, and more than that in 4 of my funds in inefficiency and arbitrage. And so if you want to know where the largest single arbitrage is in the world today, it's the arbitrage, the inefficient pricing between farm gate in sub-Saharan Africa and regional markets. And it's in excess of $800 billion to $1.1 trillion per year. So if you are just a greedy capitalist pig wanting to make money, you should be in Africa. If you are someone wanting to solve for poverty, you should be in Africa. If you're wanting to solve for hunger, 600+ million farmers that are going to feed the next billion people coming to the planet in the next decade to 2 decades live in Africa. It is the place to focus. It doesn't mean we don't need to look at Bangladesh and Southeast Asia and increasing production in South America. But if you want the largest opportunity on a risk-adjusted basis, it does lie in Africa. So coming strictly from a risk perspective and an opportunity perspective, Africa is the place you need to be. That being said, it does come with its series of risks. Most of those come in tandem with all of the other levels of inefficiency. Some of that comes from government, corruption in government, inability to write contracts that have legal binding. And so you've got to create solutions that get past that work even without those operational efficiencies. And so what we found is the solution is largely, we found it in 2 ways. One is kind of what Susan's done, which is vertically integrating that ag space, working on the soil and the seed and the fertilizer and the plants and harvesting and processing to the market. by integrating all of those, you're not held up by the logistics side. You're not held up by the processing side. If there's not enough processors to buy what you have, you process it yourself and that sort of thing. But there needs to be a certain level of efficiency built into your approach, which several people here have talked about, a systematic approach. And that systematic approach is something that we've been proposing for the past 5 or 7 years. I serve as well as an advisor to the USAID on the board of BIFAD, the Bureau for International Food and Agriculture Development. And one of the things that they've done successfully over the past 3 or 4 years is to start moving from a programmatic to a systematic preference, where we gather people together that are working on seed, soil, fertilizer, irrigation, climate adaptability, all of those things together in a single cohort. Reduces the outside risks, and it reduces the investment risk. So when you're going to bring in groups like AID and Sammy's group, CDC and FMO and KFW and all of the others, I think that they can see the value, because many of those folks come from an investment background. And that investment background says we look at something with all of the relative risk, not just with the single investment risk. What does the rest of the market hold, and how do you mitigate that risk? So by investing in things that are systematic, we find that we can reduce the risk. So when, one of the things that I would urge today is that as we look at investments or we consider things in Africa, we look to collaborate, because that's where we'll find a lot of additional value. What I wanted to share today is another innovative opportunity, or another innovative way that we found things to work well, and that's in media. And in the United States and in Europe and a lot of other places, we have kind of a negative attitude about media in many instances, because media, you have different sides and different influences and what have you, but the bottom line is it is influential. And what we found in Africa, and I found this out through my work at USAID, was that people watching TV in rural areas are often watching it not just for entertainment, but for the educational value. And many of the most successful shows are edutainment, educational entertainment. And to cut to the chase, we purchased a media company that was an award-winning company. It won 7 awards through the African Economic Challenge Fund, AID, DFID, I think through CDC, Rockefeller Foundation, and others, for its impact in social and agricultural influence in the region. And now this company called MEDII, which is like media with an E on the end, has about 12 million weekly viewers. USAID did a large study to see how that media impacted local farmers. So it did an independent study across 25 counties in Kenya. And they found that of the 9 million people or so that it reached, a new show reached 4.6 million farmers in the first season, 4.6 million. And in doing a very detailed, statistically significant study through Reading University in the UK, they found that 36% of the people watching the show, 36%, actually adjusted their methodologies for farming. And that was for cows and chickens and pigs, as well as for maize and soy, wheat and sorghum. 36% adjusted their methodologies, the way they prepared the soil, the type of seed they used, when they irrigated, how they harvested, how they stored, where they access markets, all of those things, because they learned it from watching the show week after week. 36% actually increased their outputs and increased their access to markets significantly enough that they were going from the edge of poverty to the edge of middle income in about 18 months. That's about 1.6 million people every 18 months. The cost of that show is about $1.2 million for a year. That's 2 seasons. So for less than $1, we're able to take people and give them the education that they need, connect them to microfinance, direct them to the proper inputs, and even now facilitate them accessing markets more directly for less than $1. Once they do that, they are substantially on their way to being sustainably and resiliently in middle income. So we're now working to take media across the continent and expanding the shows. And some of those shows, including something called No Zone, which is a STEM education for youth. We found that girls actually increased their grades 17% per year by watching an hour a day in school. So every public school kid in Kenya now sees the No Zone 1 hour a day in school. 15% increase in grades for boys as well. But simple things like this, where education is the core component, are, we find, the catalyst to many, many other things. So the four things that we see combined together are especially for agriculture, which we believe that agriculture is then the catalyst for pulling people out of poverty, and as well as solving the problem of feeding the next billion people on the planet. We found that education is the biggest and most important. The second, access to education, then access to inputs, quality inputs. And many of the farmers do not grow the quality of inputs they need. So we need to get more people growing better seeds and more access to finance for those inputs, which is the third, access to finance. And they don't need to have finance that's for poor quality seeds or for what have you, but they need to be linked as part of that ecosystem, the education to know what seeds to use for where they live and what they're doing, the access to those inputs, the access to finance in part for those inputs, and the fourth is access to markets. In the US, the average number of transactions in a commodity trade is 1. Many groups, Whole Foods, King Super, Kroger, and others, buy directly from farmers. In sub-Saharan Africa, the number of average transactions for a commodity is 9. Every person is adding in the middle. That creates a level of inefficiency that's just not tenable. Farmers are going to continue to get squeezed for pricing, and markets are going to continue to have prices that are higher than they're acceptable. Not to mention, you won't be able to export when you have prices that are that high. And so what we focus on is increasing quality so that it's an export quality. It's usable and nutritious in country. The variety of plants grown creates a nutritious diet, but also opens up foreign markets to other purchasing. And then we provide a marketplace. So World Food Bank, which is our parent company, will come in now and on this effort, offer to buy from farmers at a guaranteed price, along with other companies coming in. So those farmers can now connect to our digital system and have access to inputs, access to education, access to microfinance, and access to markets. The digital system is where we found the most impact when we offered that simple solution of information for when to plant and how to plant for your specific crops and your specific GPS coordinates. We're signing up 100,000 people a month just in Kenya. Of those 100,000, we took one set of 100,000, connected them to microfinance and said, how many of you would like access to microfinance? 61,000 responded affirmatively. And about 27,500 of those actually qualified. So we're expediting the access for well-educated farmers to buy high quality inputs, and we're reducing the risk to the bank, to the lender, to the marketplace by guaranteeing offtake. If the price goes higher, that's fantastic for the farmer, but they get the guarantee that the price is going to be at least this level, which justifies their spending the money on those inputs and making the extra efforts to pay for irrigation and those other things that are needed to grow higher quality. So my push, I guess, now is to think outside the box. Think of other things that we can do to influence farmers at scale. Right now, we're on target to reach about 140 million people at the end of 5 years. That's real scale. And we'd love to partner with anybody that has any ideas or thoughts or processes there. And we are looking for other folks as we grow across the continent of Africa. So I'll stop there. It's been 7 minutes, and I'll stop and see if there's other questions or what have you. I'll turn it back to you, Susan. Thank you.
Really interesting. I absolutely love the media arm of your business string. I mean, it's fantastic, and the reach of it is so vast. Very, very exciting. Thank you very much for that, Richard. And now we have our panelists. And I think our panelists are all online, but welcome to all of you. And thank you so much, all of you, before you begin, for giving your time today to cover the investable sectors of interest in Africa. I think it's probably best for us to, I'd like each of you, in fact, to start by introducing yourselves and telling us in a couple of minutes what you do, how long you've done it for, and why you do it. Can we start with Sabelo?
Sure, Susan. Good morning and good evening to all of you, depending on your time zones. My name is Sabelo Sithebe Marishane. I'm the co-founder of Umkati Wetu Holdings, a South African-based private equity and venture capital on-balance sheet investor. Our business utilizes institutional funding, and we scour small, mid, and large cap unlisted markets for opportunities to partner with interesting management teams who are solving really complex and powerful problems. We've been doing this for about 4 years as Umkhati Wetu, with another 7 years prior to that in institutions. And yeah, thanks for having us on. Very excited.
Thank you. Rowan from Investec.
Hi, name Rowan King. Sorry, it's my wife's sort of name there. I couldn't get on through our systems onto a Zoom call, so I had to make ulterior plans. Yeah, I head up the leverage finance lending into Africa. We focus on tier 1 financial institutions, corporates, sovereign, as well as property transactions. So yeah, we very much, I'd say very much the same as you guys sort of looking into Africa. I've been doing this for the last 8 years, and we've taken the deep dive from the top in terms of top-down approach to chosen countries. We don't do lending into all the different jurisdictions in Africa. We very much focus on Southern and Eastern Africa, with certain markets in West Africa. And we've taken a very pragmatic top-down approach to our chosen countries through looking at the rule of law, the exchange control environment, as well as the accounting and legal framework. So that's sort of how we started assessing our risk appetite, and it is more on the debt side than on the equity side.
Thank you. Mfo from IMA.
Thank you, Susan. Good evening, my time. My name is Mpho. I'm a co-founder of EMA Group. We are an impact investor, unapologetically with a strong gender lens applied at different levels of our organization. And we also have a non-profit organization called Imanati, non-profit company, which provides technical assistance to largely women-owned, women-led businesses. We're currently only operating in South Africa, but we are aiming to extend ourselves throughout the rest of sub-Saharan Africa in the few years to come. And I guess when you're asking why we're doing this, we're seeking to de-risk some of the SMEs that are in the market, so that they can actually, to make them more desirable, so that they can participate in the mainstream economy and be more desirable to your mainstream investors. So that is the technical assistance that we're providing and the catalytic capital that we aim to raise.
Great, thank you. Looney, Africa Eats.
Hi, so you keep hearing the words SME and missing middle. I run Fledge, which is a global network of impact accelerators that finds great SMEs, great startups, invests in them, trains them, makes them better. And then last year we spun out 27 of those companies into Africa Eats, which is a permanent capital holding company, a new structure to attract billions of dollars into the African continent.
Thank you very much. And Brianna. Brianna,
you're on mute. You're on mute, Brianna. There we go.
I am still on mute. Okay. Can you guys hear me right?
We can hear you. We can hear you.
I hope that my internet is going to be all right with you guys, but I'm Brianna. I am co-founder of Movement, a company that compels action. I started off in the entertainment business about 15 years ago, and I fell in love with storytelling. I wanted to start telling stories that mattered and made impact around the world. And I met this baby elephant that was caught in a snare trap a few years ago, and that's what kind of changed it all for me. And I learned this lesson that we must heal and be with the humans to heal the animals or any other part of the planet that we have to luckily get to exist on. So yeah, I'm excited to tell you guys more about Move Me and where we're at.
And where are you? You've just moved to Africa.
I just moved to South Africa 1 week ago. I picked up and moved out of my house from America. And
Perfect timing.
And it is treating me so well.
Great.
Yes. I am discovering all of the magic of South Africa very quickly.
Great, thank you. Sabelo, can you tell me what opportunities there are in your sector and give a couple of examples with some results that you've had?
Sure, Susan. So how we like to look at the world, of South Africa in particular, is across asset classes. So we'd separate it into private equity and venture capital. From a private equity perspective, I think a lot more desirable if you're looking to deploy large amounts of capital. When you look at the JSE, which is our stock exchange, there are opportunities in the large cap and the mid cap space for potential delistings, companies of really good quality whose share prices have been depressed through COVID, through general emerging markets a risk aversion. You also find in the middle cap space, a lot of entrepreneurs who've got concentrated value in businesses that they've created, even those that aren't listed, and are looking for exposure diversification. So sitting there with the business they started, not sure what to do with itself, and private equity investors like ourselves can come along and assist them to diversify and take their businesses to the next stage. Then in the small cap space, in the private equity segment, yet again, you're finding an aging entrepreneurial class. It's a theme that we've picked up on in the last 4 or 5 years, where good, hardworking citizens have built a business over the last 15, 20 years. There are children who are upwardly mobile, have left South Africa and are in London, New York, Australia, and aren't sure what they're going to do with their businesses. And that provides a really interesting consolidation approach or opportunity for platform assets. From a sector standpoint, technological enablement is a really, really powerful segment at the moment. It's where Umkati Wetu prefers to invest, actually, and that's where you're providing software solutions to B2B or B2B platforms to established companies, really removing some of those inefficiencies that previous speakers have spoken to, be they environmental, governmental, regulatory, anything really to try and ease the barriers to doing business, especially in South Africa. Industrial assets, which can be cyclical, are doing quite well and have an opportunity there. And anywhere where you're really competing against government in South Africa, you've got a good chance. Healthcare, private education, renewable energy for those specialized investors. I mean, those are really good opportunities. And then, sorry to ramble here, but from a venture capital perspective, we find that, yet again, we use the word infrastructure or enablement infrastructure, but really it's technologies that are allowing access to historically inaccessible sectors. So fintech is really big in Africa at the moment. You've seen transactions like Paystack being acquired by, for $200 million by Stripe, Flutterwave raising $170 million on a unicorn valuation out of Nigeria, Chipper Cash raising $100 million Series C, and really painting the story and the picture of a thesis that we really like, and that's talent is normally distributed, which means there are people who are capable all over the world. And our aim is to try and find them in the markets where we live through the networks that we've built, and nurture them to the stages where they can attract international and global, not only capital, but take their solutions onto global stages and actually impact the environments and business environments around them directly and indirectly in overseas nations. So that is, as best in a nutshell, the themes that we find really, really intriguing down here in South Africa.
One last point. You work in partnership, don't you, quite often? Is that correct?
Definitely. So our preferred method of investing is co-investment. We think it's just great to have as many solutions-orientated people around the table as possible. It also allows for wider networks, and truth be told, in South Africa and Africa in general, the more people you know who can help you and assist you with different views, different paradigms, and different solutions, the better for your chance of investing. Also, it allows the spreading of risk. It allows one to create a far more balanced portfolio, and that's how we've pivoted into or morphed into a private equity and venture capital investor. We think it allows a lot more balanced return, limits our downside, and allows us to spread risk around with people who we can see the world in a similar way with.
Great, thank you. Rowan, what are the opportunities in your sector, in the corporate sector, corporate lending sector?
So where we focus on is not necessarily the listed entities in a different jurisdiction. So we focus on that sort of that layer just below the listed entities, but also on big family conglomerates. So where you're finding transactions difficult in sort of East Africa, if I talk about them specifically, because that's where we've been mostly focused on the trading side of things, is you have these large family conglomerates which own 20, 30 companies, and there's no group structure. There's no way of really understanding what that company actually earns. And a lot of our work goes into talking to the management and trying to set up a structure in order to understand where you can lend to in that sector or in sort of that conglomerate. So, you know, the industries that we focus on is very much the FMCG space, agri-processing we look at. And then, you know, one thing that we came out and we chatted about, Susan, also is, you know, from an infrastructure point of view, there's always this food shortage in Africa. And you know, you read a lot of research around 30 to 40% of agricultural produce is lost on the way to market from a perishing point of view, etc. So you know, there's not a very good value chain from a cold storage point of view. And yet those things are very important to moving Africa forward, to setting up that and actually generating a lot of income, and also to be able to produce enough food for each country on its own.
Interesting. Have you had some, I mean, is it largely, you know, profitable and productive? Are you finding it very high risk? I mean, how do you find it in terms of profitability?
From a profitability point of view, we found it very good, but we are very strategic in how we go about it. So you know, Investec doesn't have offices on the ground in Africa. We do partner with the local banks. So we come in as sort of like a big brother partner to help them sort of breach their single obligor limits. We lend alongside them, and we also use financial advisors. You know, a lot of these corporates are guys that have started 30, 40 years ago, and they bought one truck and they started sort of transporting goods. Now they run a fleet of 1,200 trucks, and they've got service stations set up every 300-400 kilometers to be able to service their own vehicles on those sort of port lines from a Kenya and a Tanzania into the landlocked countries. So yeah, it's been very, very profitable, but you've got to be very wary. You've got to know your risks, and you've got to be talking to the people face to face. So obviously before the pandemic, I mean, I was in country probably a week a month. And I mean, some of the guys sort of looked at us saying, you know, we see you more often than we actually see our local bankers. And that's the sort of perception we want to create. We're there to partner with the guys. And I think also, you know, a lot of the banking facilities that are provided to these corporates on the ground are very vanilla structures, where you know we structure debt according to the needs of the underlying corporate, from a repayment point of view, from an interest point of view. All of that gets taken into account, and that's where we've sort of been able to set ourselves apart from the competitors who are not necessarily in touch on the ground.
Interesting.
So, could I just ask, are you doing this from your general balance sheet, or do you have a dedicated source of capital for this?
So we're doing it from our general balance sheet, but over time, what we are looking to try and do is we've got a sort of team that's starting to look at setting up co-investment funds to be able to get bigger transactions out there. So where you've got a corporate who probably needs a $50 to $75 million lend, you know, we would look in at doing anywhere between 25 and 40, but then we would probably look for a co-investor to come alongside us. So we would do a lot of the analysis, we would do the presentations, and we are looking to set up some sort of a co-investment fund for people looking to come on into the continent and assume that risk.
And quick follow-up, what coupon, if we were to co-invest with you, might expect on a range?
So we don't really go down the risk channel as much as some guys will do. So we sort of lending in that sort of 6% to 7% yield in the 5-year space. You know, in the short dated space, you're looking at the 4 to 4.5% in up to the 1-year space. So what we found, especially in Africa, is your risk curve is quite steep in the 1 to 2 year space, but it generally starts flattening out the longer that you're there. You know, it's not as risky the longer you're there. It's a short term getting to know the guys up front is where the risk pays.
Interesting. That's actually substantially lower than I expected you to say.
Yeah, it's going for what we feel is the right risk mitigation, but you know, our returns as a bank are also based on the security that you're given. So, you know, we're taking sort of 1.5 to 2 times cover from a security point of view, you know, to do those lends. So, you know, it does help us reduce the pricing. You know, I'm very wary of going into those higher yielding spaces, especially in the East African market, because you're generally finding a company that can be in a bit of distress. Yeah. You're going sort of, in my mind, anywhere north of 8%.
Yeah. Because I mean, we see 10% and 12% quite often. So that I mean, and that is, you know, across the board in ag, you see higher rates than that generally. So that's interesting. Thank you very much. Mfo, what are the current failings in the alternative investments industry that led you to identify a gap for your fund?
So I think sometimes I'm harsh when I call them failings because I think, everyone's doing the best that they can. But, in our experience as players in the private equity space, mezzanine funding space, entrepreneurs in our own right, that is the mixture of our co-founders. We discovered that firstly in the impact investing industry, there are some players in the sector that have a tick box exercise approach to impact investing, especially when you start discussing gender lens investing. That is why we walked away from the approach of just looking at women ownership, because it does become a tick box exercise and you're not looking at genuine gender inclusion and looking at the actual operations of the business, the value chain of the business, and other opportunities to actually apply your gender lens. We also saw, and I'm glad throughout all the speakers' presentations and all the discussion, this has been stressed, the importance of partnerships. While there's a lot happening in terms of partnerships, we felt that there's still a disconnect. And we saw that especially in our own entrepreneurial endeavors, there's still a disconnect between all your different parties, between your government initiatives, your intermediaries, your accelerators and incubators, and then the SMEs themselves. It gets worse when now you look at it and you confine it to just, from a gender perspective, your women-owned, your women entrepreneurs. There's a huge disconnect. So we sought to actually sit in that middle and start connecting the different players initially, and that's what we're doing with our nonprofit. Another incredible failing that I think keeps us from actually expanding the economy as much as we could is that, particularly in the private equity space, we are still approaching deal sourcing in the same ways we always have. The most natural way to source deals is through your networks. It's through people you have worked with in the past, people that you engage with at forums and conferences, discussions that we have in these forums. That's your most common way of sourcing deals. And still, we're not actually accessing, especially women entrepreneurs, and these archaic forms of sourcing deals. So we need to look at more innovative ways of sourcing pipeline and prevent what we have observed to be actually passing the same subset of deals amongst different private equity houses, and thinking that we're actually going to truly tap into the potential that this continent has without expanding on that. So these are just some of the gaps, as opposed to failings. I'd say the gaps that led us to actually start looking at forming EMA Group.
Can you just give us one brief example of one of your pipeline deals? Because you had some really interesting deals on the table. So give us one succinctly. That would be fascinating.
Happily so, and this is a question that excites me. So we use our nonprofit company, which provides technical assistance, to actually aid in mining these deals for the fund. And one such deal is a female entrepreneur. She lost everything, in the lead up and in the mess of the COVID crisis. And she has turned that around and not only helped herself recover, but she's also helping a number of other SMEs. And she's an entrepreneur in the ghost kitchen industry, which is an industry that I wasn't even fully aware of before engaging with her. It is amazing the potential that this entrepreneur has. And we believe between now and the next 2-3 years, she will need the sort of investment minimums that our private equity players are looking for. And we believe that by assisting her and just corporatizing of her idea, it is running well, we think, at the moment for its size, but as it's growing and it's growing far beyond her expectations, she is going to need expertise and assistance in this regard. But we believe in the next 2-3 years, she will be a huge competitor in this space. So these are the sort of deals and people that we're engaging with.
Great, thank you. Thank you. Looney, why is there so little investment in African startups, in your opinion?
It's crazy enough, I'm going to say, because it doesn't cost enough to start a startup.
Yeah.
Because it's a low cost effort. I would say if all the startups were of the scale that you were talking about in your keynote, then there'd be more attention to fewer deals and bigger checks could get written. The problem is, what I've seen is most of the companies out there need $25,000, $30,000, $50,000, maybe $100,000 at the high end to get started. Case in point, Fledge does a program with World Resources Institute called the Land Accelerator. We had 1,300 applications for the program this year, and we accepted 100 of them. And of the 100 that we accepted, maybe 3 of them are big enough to take a $500,000 check. The bulk of them, again, they need $50,000 to $100,000.
And what are they doing with that money?
What do they need? Well, they need that money to buy some equipment, to fill the operational capital gap when you actually get orders, when the good customers out there pay you net 30, but you have to pay the farmers right now. They need a truck, and there's no truck leasing. There's no truck finance. You have to buy a truck by finding a used truck and just buying it. They just need to get a company off the ground, and that costs money. These things can't always be bootstrapped. And then the problem is these checks are small. And so the institutions that are out there, most of them can't write a check that small. The angels who could don't know about the deals, and the entrepreneurs have no access to the angels. And so we're left with what we're calling the missing middle. There's a huge gap. So when you said, I laughed when you said smaller than $10 million. $10 million could fund hundreds of these. Not one. We're not talking about one company needing, $9 million and having trouble. We're literally talking about 1,300 companies that all applied to one program. And okay, if we screen them out and said there's 500 good ideas in there, yeah, we could put $5 or $6 million into those 500 companies efficiently. And then we would have 500 or 600 solutions working with 300,000 or 400,000 smallholder farmers and growing and solving real problems.
You're so right, because what we find is that the numbers are too small. I mean, if we need to borrow borrow $2 to $4 million on a project, that's too small. And the minimum ticket often is $15 million and
Yeah,
10 million if you're lucky.
Yeah, I talked to the CDC a few years ago about Africa Eats before we got off the ground, and it was a really quick conversation. They're like, come back when you need $30 million or 30 million pounds.
Yeah.
I'm like, well, it's hard to deploy 30 million pounds across 20 or 30 companies. Like, then I have to go and build a portfolio of 200.
Yeah.
Almost there now. I'm pretty much ready to make that ask again. But it's hard to efficiently deploy that capital.
Yeah. Thank you. Brianna, can you, you're in a space that is fairly, I guess, unusual in Africa. Can you describe why you think you're going to succeed in it and how it's investable?
Yes, and just to clarify, I know we did just a very quick intro before, just to explain a little bit more of what we're actually up to here is that we have created an impact campaign, which we have turned into a 7-episode docuseries to uplift a narrative feature film that covers the anti-poaching world. So each one of these 7 episodes will be touching on, the highlights of beautiful South Africa and everything it has to offer. It's a way for us to get audiences closer to the people in these villages that we've actually met over the years that want to make a positive impact and change around the world. So alongside featuring this docuseries, we want to be showing the creation of our first abundant village, which utilizes shared services and help solve some of these big challenges that locals have actually, discussed with us, being water, food, and energy security. So we want to demonstrate the first abundant village and build the foundation of it. And this is where we need a lot of people's help, and tech companies and agriculture and basically what everybody on this incredible chat tonight has brought to my attention. But these are the stories to inspire people and bring people into action. So some of our leveraging networks are in Silicon Valley, and of course, finding local solutions to help solve these challenges. And some of the companies that we've actually been talking to is Source, which is a company that actually can pull water out of the atmosphere. And a small system of theirs can create 50 to 100 liters of water per day. Aquaponics, of course, and solar panels, as you all know about, are a pretty hot topic for all of us. But of course are building our network still and learning a lot and looking for any resources and referrals that you guys are willing to bring to us. And then Susan, tell me what your other part of that question was succeeding.
No, how is it investable? you're making a 7-part docuseries, and in terms of investment in what you're doing, how is that investable? I mean, is there the corporate is MoveMe LLC, and can you just discuss that a bit further?
Yes. So MoveMe LLC is its own company where the docuseries will lie and the film will lie.
Got it. Okay.
Can you hear me? Can you hear me?
Yeah, we can. Go ahead.
We can hear you. Yeah.
Yeah, we can
No,
hear
we
you.
can hear you. Actually, I'm Stuart. I'm her business partner on this, and one of the things, and she's in Hootsuite now, and so the coverage is a little weak. So
Stuart,
anyway,
I'm hoping that's talking. If it is,
I am, yeah. So that's great.
Okay.
So anyway, what makes this investable is that we're pioneering a model called profitable social impact. So I come from Silicon Valley. I've been here 25 years. My entire career, I work at Deloitte as my day job. And what we're trying to do is figure out, how do you generate enough revenue to create projects that are sustainable on their own? So while you might get investment or partnership in the beginning, you've got to be able to create something that's sustainable, that's run locally, that's secure, that's safe, that can scale. So what we're doing in the pilot village for Abundant Village is that we're going to build these technologies. Let's say it's $500,000. Then those technologies will generate revenue. That revenue is shared locally, shared with the investors, and shared with the house. Then ultimately what we want to do is scale these so that as we come up with this village that can be put on any 1 acre site, 2 acre site, we can then scale this across South Africa and throughout the continent to be able to figure out the best possible way to generate more revenue and solve these consistent problems, which is water, food, and energy security. And sorry for the way I look. I just arrived in Johannesburg about an hour ago. So anyway, glad to be here. I'm coming here for a month to work on this project with Brianna.
Oh, that's brilliant. Thank you. Last question, everyone, because we're running out of time and we've only got a few minutes left. But just very briefly, in about a minute each, or a couple of minutes each, can you explain what you believe is your edge in your business? Sibylla, what is your edge?
I think asset allocation really has been crucial to us. When we look at our portfolio, we've had an ability to generate a 49.1% USD IRR across our private equity portfolio. Our ability to connect with entrepreneurs in our VC portfolio has led us to invest in 2 companies which we're looking to take over to the US as part of our foundational thesis of South African technology that can be scaled globally. And to that end, we'll be looking to raise a US-based fund that will look and further that thesis forward. So yeah, we just think prudent asset allocation and partnering with good people. And sadly, that's something you really only get when you're in country.
The 49% return you're referring to, over what time frame is that?
That's over 4 years.
Okay, great. Thank you. That's great. And Rowan, what is your edge with what you're doing?
My edge is finding the right clients on the ground and being able to tailor sort of a debt package which helps the expansion of those local corporates, and making sure that when we're on the ground, we are sort of checking their manufacturing plants and actually doing a proper sort of boots on the ground analysis. And yeah, basically the out of the ordinary service that you get from an Investec point of view, and making sure that the product fits the solution and the client.
I mean, Investec, is an investment bank, would you say? I mean, it's regarded as sort of one of the premier investment banks.
Yes, we're the 5th biggest bank in South Africa, but we're not a retail bank. So we have a high net worth sort of private banking sector of about 90 to 100,000 clients. That's about it. And then the rest of it is pretty much the wealth and investment side of it, as well as then the banking, the corporate institutional banking and property portfolio. So that's what we do.
Good, thank you. Mfo, what's your edge with IMA?
I think our edge is absolutely our construct. As with any impact investing asset, you do expect suboptimal financial returns. But I think because we have that in-house technical assistance through our nonprofit, which has ring-fenced that skill and ring-fenced the costs of that, we are able to provide our investors really competitive financial returns while still achieving the impact targets that we seek to achieve. So I think just having that in-house and having this unique construct, we achieve our gender inclusion targets, but we also still provide quite attractive returns.
And your competition in that space must be still quite low, is that correct?
Absolutely, absolutely. There are not many funds. It is growing. I mean, for instance, in 2020, I think the Global Impact Investing Network, GIN, reported that about 43% of all impact funds are coming to Africa. So it is a growing market, and every year this number increases. So I don't think that will be our edge forever, but I think there's so much opportunity that, if anything, we welcome more people in this space.
Yeah, the gender lens, I think, is quite unique still. And that is
definitely. Absolutely.
Looney, what is your edge?
It's relationships. So between the accelerator and this investment holding company model that we just spun up, we sit on the same side of the table as our investees, which sounds weird and crazy and impossible, but we do. So when they make an ask of us, we sit down and talk about their business, but we already know most of their business already. They're not sitting across the table like at a bank or a lender trying to prove that they need money. They're just trying to prove to us that that's the right amount of money. And then when we have it, we write the check. We talk about terms with them, and it's not always the same terms. Everything's bespoke based on what they need.
And your differentiating factor must be that you put a whole lot of training and support in way beyond the funding.
Yeah, so we found all these companies through the accelerator. So I said we had 1,300 apply this year. Over the years, it's thousands. We then pick the top 1% or 2% of those companies, bring them in for a few months and train them on how to be better entrepreneurs. And in doing that, we learn about their company because we've stripped apart their business plan and helped them rewrite it from scratch. And we've usually picked them up out of their home country and brought them to a new city for 2 months. And so we have a real relationship with them, and we continue that on as they're growing. And that's in the Africa Eats world. We think of that as the next stage of accelerator. And now we're trying to get them past $1 million a year to $10 million a year. But every time we have something pop up with them, whether it's advice on a strategic decision, like a board member would do, or an ask for money, which is the more common ask we get, we literally just sit on their side of the table and work with them on their business plan and figure out what they actually need. And if that means we bring in a co-investor, we'll do that as well. So we're doing whatever we can to help them grow as if we were a co-founder.
Yeah.
Susan, do you mind if and John, Rob, patience for one moment. I have two quick questions. Do you work with other accelerators in terms of the collaboration? Oh, by the way, one of your flock, Evernew, we're talking to them. One of your early accelerate.
That's an American one, and when we're talking about
yeah, no, but it's still great to have connectivity that way.
Yeah.
So we're talking to Antler, another global accelerator. Just curious if you collaborate, and then who do you hand off for the next stage? Like where is it, and does that matter by region?
Yeah. So the first question: do we work with other accelerators? Yes and no. We're a global network of accelerators. We're not one big top-down hierarchical org. And so I run Fledge Seattle, and I run the whole network. I run Africa Eats, which is a spinoff of Fledge Seattle. But the companies in Africa Eats attended Fledge Barcelona, Fledge Peru, the Nature Accelerator in Padua, Italy, and the Land Accelerator, which are all run by other organizations. So we help them get their accelerators going. But no, I don't grab companies from other accelerators that are, I don't want to say competitive, but that found these companies, because then we don't know them. And frankly, we just don't have enough money to support the ones that came through our programs.
And then who are your next round investors?
Oh God, we talk to every impact investor we can find in the world. I have a database of hundreds, and Most of them
in-
can't write a check small enough.
But in-
So the
in
ones that
Africa.
have would be like Goodwell, Acumen, Hevos, Finca. I don't want to leave them out. AgDevCo. There's a whole long list of co-investors that have come in alongside us.
Those are all in Africa?
Those are
Five
just
you
the ones in
mentioned?
Africa, yeah.
Sorry, go
Yeah,
ahead.
the ones that,
Oh,
I don't
sorry.
want to list all the US. That's even longer.
Finally, Stuart, what do you think your edge is in this business venture?
I was typing
go ahead,
to him
Brianna.
in case
Yeah.
you can't hear me, and if I get cut off, please speak up. But yes, for me the edge is human transformation and connection of humans and partnership, and we would love to call our investors stakeholders because we want them to be a part of this with us and involved and aligned with us and just really a part of this with us. We wholeheartedly believe in this. And I believe that if you can change the heart of one, you can change the heart of many. And storytelling has changed my life. And I believe that we can inspire others around the world and uplift and heal. And that goes a long way. Stuart, anything else? Did you hear all this?
So we're bringing business acumen to the social impact space. And so we're a seasoned business professional, newer to social impact, but we want to figure out how to create profit across many approaches. We look at ROI in 3 different ways. It's return of investment, return on investment, and return on impact. And so we're very focused on building that model first and coming out with how do we scale and repeat in a meaningful way. And so I've written down a lot of names of fascinating people on this call. So we'd love to reach out, and I've got a massive network here in Silicon Valley, and happy to share my network to help you accomplish your specific goals as well. And I know Brianna is the same way. So thank you.
But when will you have the first film prepared, the first docuseries?
So we start filming the 28th, and we're just barely shy of the first episode. So we have raised the funding for the first one. That will be edited within about a month, and then we'll be starting pre-production just 2 weeks after we wrap up this one for the next 7 episodes. So we are not fully picked up by a network yet, and we have the options of either find a network to pick up the whole season or sticking with angel investors to close up the entire season and put this out privately so that we can keep control of the creative side of it all.
Great. Well, thank you. Well, that brings us to a close. Thank you very much, panelists. We've really appreciated your input, and it's been fascinating. And thank you all for joining us in our Africa Deep Dive event. It's been a really interesting afternoon, but the same themes have been repeated quite a few times. And that includes problem solving, partnerships, the power of partnerships, the reality and the necessity of partnerships in Africa, and access to funding, etc. So watch this space, but I do agree with Richard. We have to all think outside the box, as Philip says, to problem solve. And this is an exciting continent. So anyway, we welcome any kind of input that you've got into this. And if you have any questions, then don't hesitate to get in touch. Thank you.
So Susan, let's call that the formal end. And if anybody wants to stick around, by tradition, we can't help ourselves. We just want to.
It's too great a group.
Hey, Mark,
It really is.
I had a question, and I think John had one. Can we pose that quickly?
Yeah.
Well, I guess
Okay.
mine's not a question. Disclaimer: Deloitte's I'm a client of Deloitte, and I've known Stuart for 3 years, and I've worked with him on helping single moms have a safe place to live, and that's how I met Brianna. And I've known her for about 2 years, and I'm in the film and movie business, and I'm invested in their project personally. And I encourage you all to get to know them. That's what I wanted to say. And Stuart, if Stuart's offered of connecting you, he's done a tremendous job helping my startup grow. So he'll pay you back, I guarantee you. That's it.
Cool. Thanks, John. Hey, Mark, it's Rob Colorina here.
Who are you? Do we know you?
Rob, who?
I'm not in the Hamptons this week, but it looks like you have a nice nice garden back there. We invested in a couple of companies in Africa. We had over 1,200 jobs there, and it was a win-win. And one in technology circuits, the other in transportation. I think to the question earlier of critical mass and size, that's not an evil thing. I think it's fantastic that
Investec, and you guys are more than an investment bank. You guys are a great asset manager. I've interfaced with you guys in Australia, UK, even US, and we've looked at business, both debt and equity, with you all there, and then CDC. So my to be here is fantastic. So my thoughts there is that there's a lot going on right now, particularly in South Africa. I think that's going to blow over. That is sort of natural for politics, but the importance from critical mass of scale of returns and rule of law and delivery. I mean, one of the things that put Africa private equity in the map was Celtel, with that transaction, and that you had private equity that exited, and then even Alexander Forbes and other large deals that Actisys was involved in, that I think Sammy CDC was in, are important to give infrastructure to both capital markets, a legal framework, and shareholder return. So the larger size deals are not sort of evil. I think they're frankly necessary to give guidance to the capital markets to allow some of the growth initiatives to go into there. So I think I wanted to see if Sammy had a thought to that. And then I guess Sabelo, I mean, in your side, we've been there. It just seems like your model is VC and PE. What are you seeing in terms of, are you seeing more opportunities coming your way, and more exiting traction? That's something I'm curious about as we're a family office investor.
Happy to go first, or is Sammy going to speak?
Go ahead, Sabelo.
Sure. So yeah, on the private equity side, I think you're exactly right, Rob. Those large ticket transactions have been good for the market in general to show established markets the fact that they can deploy in South Africa. So it is a stable country, I guess, barring the fracas we've got at the moment. But over time, it does revert to the mean, and you do get good returns. I mean, typically in South Africa, we always look at the 3 times money over 5 years, giving you the 30% IRR, and you do anything worse than that, you're really not well regarded. And we are still seeing larger deals being announced in the SA market. From a private equity perspective, in the mid cap, it's a little bit quieter. There is still flow, but I think to Paul's point, you're now seeing that a little bit more constraint or constriction. It's starting to pool or aggregate around a certain number of really high quality deals, but this is all a part and parcel of markets. We all know that, the ebb and flow. From what we're seeing as UW, and maybe it's a little bit to Looney's point, I mean, we do see a substantial amount of venture capital flow. I think the tough part we're trying to solve for is matching capital that we've got access to and that we sit with on balance sheet, with the opportunities to invest and return that capital with a return. Unfortunately, we don't sit in the impact space, so we have to be exceptionally difficult and exceptionally tough on some of the opportunities we look at to ensure that we can still churn assets, churn capital, and still help good entrepreneurs. I think if we've got access to greater capital, we can do a lot more. Yeah, so pretty much that's it. We do see the flow, the opportunities are there. It's really about matching capital and those underlying assets that we get to see.
We didn't talk today about how you get your money back out, especially in the VC space in the early stage and the SMEs. That's one of the challenges. Is there just isn't you see all the heads nodding. There's no real exit path yet.
Yeah.
So we have a solution to that at Africa Eats, which is not to worry about it. Instead, take the whole portfolio public. Yeah. So we think we've solved that problem, but
one thing I wanted to bring up that I'm learning from working with VC venture capitalists in Japan is one of their concepts is around, instead of providing venture capital, it's venture capital plus debt plus contracts. And I think with our network here, Mark and team, providing contracts to these companies almost more valuable than just the capital alone.
No, it's talent and strategic partners. It's not just capital. And I learned that, in fact, we had a business in Mozambique, and the key was to stand up a terminal, you needed the throughput contract. And without that, the deal didn't happen. I didn't have this network. And that second port didn't happen. and what competition it would have created, all the things it could have been. And it's just, that's what our network should be about. And if Susan's going to create the largest cannabis grow in Africa, we have distribution into Europe, or we have distribution into whatever market. So that's what we're trying to do.
Yeah, to Rob's question earlier, as far as CDC is concerned, our strategies have evolved. However, keep in mind that we have a number of tools, product tools that meet various market needs. So from having your plain debt products, where the ticket sizes range from $10 to $15 million all the way to $100 million, to direct equity, where we start at a minimum of 20 million, going up to 80 million. However, we have flexibility in approach through venture capital, where we have recently, and this is public information, engaged in a transformational investment in a company called Cropin, based out of India, which focuses on ag tech and delivery of technology through remote and ground level sensors. And of course, your data analytics. And on top of that, we have an intermediate route through funds. Just in the food and agriculture sector alone in Africa, I think with over 15 GPs, we have investments in over 135 investee companies. So we have a whole range approach, but yes, under the direction of our shareholder, the FCDO, we do realize in order to for us to achieve impact at scale, we need to make investments at scale. But we also need to keep in mind that the investments we make in scale are benefiting all the stakeholders across the value chain. And in the case of food and agriculture, our equation on inclusivity means that small holders have to play an essential part.
Mark, could I add something to that?
Yeah, of course, Rich. Rich, I just want to make sure you get on with Kroger. You got to come to the Midwest too. That's the other emerging market.
Conversation with them, and that's a topic for another day. But we have a technology that allows us to take foods, especially powdered mango, banana, papaya, all of this stuff that goes to waste. We can dry it and powder it and have a many-year shelf life for one. But now we're able to take those foods and make full nutrition, 26 minerals and vitamins, all the nutrition, calories, carbs, proteins, enzymes, everything you need for a full day for 15 cents. So and that's the product that'll actually go into retail stores in the US, and we're working on launching that now in partnership with USDA to fill the gap for the feeding programs in the US, for SNAP programs. But
Richard, what's the name of that company again?
It's Africa. Pardon?
What's the name of that company again?
That's under World Food Bank.
World Food. Okay, that's one of yours. Okay.
And so that's one piece that also helps manage post-harvest loss and all that outside. But what I wanted to chat about and kind of direct it towards Sammy, and as much a question as a comment. One of the challenges that we have, same thing at USAID and other places, is that there is that gap. We fund the larger things, and then sometimes we push money to funds to fund the smaller things, but there's not a link between those. And if there were a way that we could have those linked together, and USAID tried that at one point using the Global Innovation Exchange, and they registered, I think, 16,000 businesses, predominantly in Africa, on that exchange. But the idea was then to connect those to SME funding organizations. And because of the change in politics, just like we have in every other country, is every 2 years, 4 years, the things change. And so you're never able to build consistency. But if we had DFIs and others that would come together and say, we're going to share this pool of up and coming companies, and we're going to push dollars out, not only for the infrastructure, but then down to the next level, because that's also helps solve the problem that we have from the Chinese model. And I know that we have a lot of Chinese investors on here, so it's not meant in deference. It's meant to just say that you have a model where you invest in infrastructure and then there's nothing built behind it. They build roads and highways and rail, but there's nothing to ride on the roads and the rail because we haven't increased the quality of production such that it can be exported. But if we take that systematic point of view and we put money into the infrastructure and concurrently put money into the next level or bringing the next level up, there will be an M&A type model. I think you'll have folks coming in, merging those logistics companies and those agro aggregators and what have you. But it could certainly be facilitated if we had groups like CDC, FMO, KFW, AID, and others gather together and create that systematic approach. So I would just say, if anybody has any interest in that from your side, Sammy, I would love to.
That's a very interesting point, Richard. We also do believe that in order to achieve the desired long-term sustainable impact, we need to tackle both the soft and hard infrastructure issues. And as I alluded to earlier, through our CDC Plus technical assistance facility, we do provide both the knowledge capital as well as the soft capital to initiate those pilots. But more importantly, on this issue of finding maybe an opportunity for M&A or consolidation of assets, we are exploring this idea of a high-value crops platform. And the high-value crops could potentially be suitable for what you talked about, with end markets mainly being in the US or North America as well as Europe. The avocados of this world, mangoes, citrus fruits, and primarily be focused on East and South Africa area. Where we will be probably looking at creating a permanent capital vehicle, which over a period of time buys, takes stakes or takes a majority stake in a number of entities. Some could be very small, some 5 million, some could be larger. But that is one opportunity we are looking at rolling out as we move forward, particularly in the food and agriculture space. And as you know, we are already sort of partners in the World Food Program in our investment in African Improved Foods in Rwanda, which we have done together with, I think, IFC, FMO, and DSM.
Right, and that's a great example. They went and built a facility, and it took 5 years to get the inputs to really meet their requirements, right? So and it's one where they went the next level down and invested in the middle space, but they didn't go all the way down. And so now the preponderance of maize and soy coming into the facility was rejected because it had a lot of aflatoxin. And that's because we need to also link it all the way down to the soil and the seed and the other folks. And now after several years, and again, a private investor, a Cargill or a Land O'Lakes or whatever, would never be able to take that many years to build to profitability. But they were able to absorb it because of the partnership with you guys and others. But even the Dutch group and DSM and others, I know it's frustrating when the vertical hasn't been done. And if we're able to come in and do that together, I think it would scale quicker and it would make things move faster. But anyway, yeah, it requires collaboration. Does CDC work with, by the way, with Convergence?
I'm not aware of that. I probably need to check internally. I'm sure there's some dialogue between one of our investment teams and Convergence.
Okay. I know Joan came out of OPIC, and they just helped put together a couple of $1 billion+ blended finance models, and I was wondering why we didn't see more from. And we're working actively to try to get AID and others involved, but that would be a perfect place, I think, for CDC and others. But anyway, thank you, Sammy. By the way, thank you for that.
Thank you. Thanks, Richard.
Sammy, I'm delighted to hear you say what you just said, because I do think that there are a whole series of investments that CDC has not yet examined closely enough in ag.
Yes, yeah. We are on, just to let you know, we are now in our new strategy cycle, which will be implemented from 2022 to 2026. And hopefully the high value crops platform would take some formation as a result on the ground from the strategy cycle.
Yeah.
Sammy, let's talk to see if my 9 years of experience screening down companies is of help to you to help you work with smaller companies.
Sure, absolutely.
Mark, it might be worth having a separate talk or call on that. We actually hosted a conference in DC called the Zero Hunger Formula, basically saying there's a math model to solving hunger as well as poverty in Africa. And part of that, a big part of that, is actually defining what's the best product to grow in a country. And in places like Rwanda, where they're not going to be competitive with maize and soy, they still need to grow a little bit of it to be for their own sovereign resiliency and sustainability in case borders are cut off between other countries. But other than that, there are certain things they can grow better and what have you. And you have landlocked countries like Uganda, where logistics eats up a lot of their potential profit. But if they did processing of oils and high value crops or powdering of fruits and vegetables, then the logistics expense becomes a lower piece. But that's one where if you need the top down, you need the groups like CDC and others as part of it. And then you need to have each of those countries or each of those groups say, we're going to focus on this area. And that model has actually worked fairly well in Kenya, where groups of counties have gotten together and said, we're going to focus on mango and avocado. And the other 12 counties say, well, we're going to focus on soybean and tomatoes. And by doing that, they create enough volume to be institutional, but they also are not now competing with one another for years and years. They essentially kind of carve out what they want to do and go for it.
Is there anyone who's done any good research on just where the gaps of crops are? Like, and in a multi-year process, because at the moment there's I think the drought in Tanzania is causing a lack of maize. But we had an issue in Uganda last year that the sorghum buyers couldn't buy, and the sorghum ultimate users, which were the breweries, had to buy through the buyers. They can't buy from farmers, and so there was a gap we had to fill in for sorghum. We just hear about these things basically on the street. We don't have any good source of information on what should the farmers grow that might be a better crop than what they're growing today.
Richard, just you all know what should happen. Almost like we just need to create a white paper and say, this is what I think, because you have boots on the ground. Like, what if there's a best, like, use your magic wand and let's just see if we can get the right capital to line up. You got logistics and others, because I was in emerging markets for 8 years. London is much better where we should be pivoting off of than the US. You know, I think our London conference, we had 4 or 5 companies had Africa funds or I mean, one was investing in brewery in Ethiopia. I think they're killing it right now. Like anything on a per capita basis, they're doing really well. I think the US is just, unfortunately, we're not as in tune. We're gonna miss the boat. But I did see, like, Parsons and Lauder had this platform years ago, and I don't know, is that going strong? Has anyone heard of it? More sub-Saharan, Dick Parsons, Ron Lauder.
No.
Never. Yeah, I don't see the family offices really being the mavericks that they should be. Even Carlyle said 2003 IMPEA conference, the next emerging market is Africa. What have they done?
Yeah.
I think we got to, like, the Tolaram group out of Singapore sold to Nabisco, right? Kellogg's. They're half. I wonder what they're doing. Like, we got to find the family offices that are scaling, and how we and
Mark,
people what Sabello is doing, and get capital into him, because that's just smart. Go ahead.
Mark, I sent you a text about, I have a group of folks that are former AID, World Bank, Carlyle, that are all looking to, and they have a lot of people that have come into some of these groups looking for, and many of them being family offices and ultra high net worth groups looking to do impact investing, but it's for profit, but with impact side model. And they just didn't have the instruments to be able to put people into that. And they didn't have the expertise on the team to be able to do that. So we put together about 10 or 12 people from all over. And we're going to look to launch a fund like that. And so I'd love to chat with you about it and have some of those people come in. And I think that the idea, though, is not only do you need that leadership of people that come with that background, you need people that have feet on the ground, and you need it all the way up. You need the loonies of the world that know people on the ground and the trend of what's going on and the opportunities that exist. You need the level of folks where he sees where they're exiting to, and the people seeing where they are linking to the next larger size. And then you need the institutional dollars, which, as a former trader, if for those of you who don't believe you can move markets, that's what I did for 20 years. I moved markets, and you can, if you build enough size, you can force them to be successful. We know tech companies and others that we've seen going, how did they do that? Their product is not that awesome. It's not that, but if you have enough money, you can actually work through a lot of the problems and resolve.
That's the thinking. I want you to have that thinking, or maybe you have it and share it with me. Let's just do it.
Yeah.
Now we have this. Now we have this platform. We never had it before.
That's right. Yeah.
Let's
Well,
do it.
we need to bring in those leaders. We need to bring in the ministers of finance and ag and all of those folks and bring them on these calls. If we can put some of that together, because they need to hear this. I mean, the president of Ghana got a standing ovation at the Agra conference a year before last, when he said, they said, you know, Ghana's doing really well. What is it that you see as your job for, you know, helping grow business? And he kind of leaned back in his chair. He said, oh, it's easy. My job is to get the hell out of the way. And he got a standing ovation. You know, his goal was to remove all of the barriers to entry, get rid of tariffs going across the border, get rid of the difficulties to open up a business, and to make it easier for people to do business. And he said, the only thing we really need to do is help people enforce contracts. Everything else is to facilitate, is to let business do what it needs to do. And if we can get more leaders kind of in that line of thought, it would be
we will, and we're going to do it. This is just catalytic.
We'll get there, but I'll tell you, after talking to hundreds of individuals and families, the most important question they ask that is usually can't be answered is, how do I get my money back out? And so if they're on the debt side, you know, they just start with the stereotype that Africans don't pay debts, which is, you know, bogus. But if we're looking at big money and we're talking equity, they ask, how do you get the money back out? And when I ask this of the Acumens and the Goodwells and the Hevos and the people doing equity investing, they just start waving their hands. They don't actually have an answer. They're just hoping that exits happen.
It's a good point. Sharing, did you want to say something? You had your hand up.
No, I was just thinking about exactly what Leonie said, that the big challenge for private sector. So I come from private sector. I cover Imperial Logistics interests in West Africa, and I also run a route to market company, which is family owned, right? So, you know, the challenges in Africa, you know, to be staying there and investing, it's a great thing that this forum is discussing the real ways of addressing that and tackling it from various levels. Now, what I want to say is that, like, I live most of my time in Nigeria nowadays, and this last 12 months, if any, has shown a lot of resilience in the consumer, and you know, there has been no big funding or aid that came into the market, but there's been a huge consumer demand. You know, the supply chains were completely disrupted, but still the demand has not completely vanished, right? So you know that these markets have the resilience for basic essential commodities. We are into food, pharma, FMCG. These are thriving. Beverages are thriving. So, you know, for all of you who probably look at Africa from a little distance, there's a huge amount of capital to be, I mean, money to be made, investments to be made. Yes, there are problems with capital controls and repatriation. That's been a big challenge. Policy frameworks are not clear. I think if we can tell the governments that, look, you can invite a lot of private capital, we are happy to stay for longer term, but you got to find ways of securing, you know, investor returns. Now, this has been a big challenge, especially in Nigeria in the last year. You know, you pay all your taxes, you do all the hard work, but you just can't get the money out. So how are you going to reinvest them? So these are real issues. Then, you know, there is negative interest rate. Inflation is running at 18, the interest rates are 13. So, you know, you really can't make economic sense and short term. But even if you are there long term, you got to find some assurances from the governments to make it work, right? Otherwise, it's going to be the cycle. Everybody will be opportunistic in trade. So anyway, great to associate with you all. Thanks.
Sharing, I actually have a slight, hi, it's Nzube here from London.
Hi, Nzube.
A quick comment, actually, because I have some exposure to a business in Nigeria, and this is more tactical. Maybe we could take it offline if you're looking to get from local currency to GBP. Then that's something my client, we do 1 million in revenues each month, and we constantly have to do a lot of Forex transfers, and it's crazy having to work on capital controls locally. So happy to look into that with you.
Sure, Nzube, look forward.
One of the ways to get around that is that you transact in Mauritius or you transact elsewhere. If you're going to buy an asset or sell an asset, you don't do it in Africa. The other is that you buy an asset and then you bring the money out as a loan. You put it in as a loan and you bring it out as a loan or as an investment. So you can take out what you put in, any kind of loan funding or any kind of investment money, depending on the jurisdiction. I mean, there are ways to do this. And the other one in South Africa is to be patient and to take it out in chunks, which of course is also tedious. But there's quite a lot of transacting that's larger transacting in Mauritius.
No, yeah, we do use those vehicles, but at the same time, there is a real issue of exchange, especially probably Nigeria is going through its phase, but they can sort it out. I'm sure, a bond issuance or something is going to come soon. But, again, the point that I would stress is it's worth a market that's investing. There's a huge amount of VC interest, like someone mentioned about the Paystack story, the Stripe story. There are so many of them. Like I know a company called 54 Gene that invested. M-Pharma from Ghana is in the space. We ourselves are looking at entering the digital space very actively now. So, the traditional businesses are also combining the digital investments so that, we can manage this analog to digital switch that is happening across, right? So yeah, so exciting time for Africa.
I think the governments have got to make it much easier, though, to do cross-border transactions.
Yeah, real life experience. There is ETLs that is there between the countries, but then the trucks just cannot cross the border. It just stays either at Togo border from Ghana or at Benin border or the other ways. So, you got to ease the kind of, see, it are regional blocks, right? Africa is 54 countries and each of them can't survive on their own. So you got to create the facilitation, and that's where bilateral trade has to happen within the blocks without any hesitation. Otherwise, these markets are too small for anyone to make any reasonable investment. So you got to open up the borders and consistently so, and there has to be some rebalancing if AFCFTA comes, the consuming nations and producing nations. So, the producing nations are always going to root for AFCFTA and consuming nations are not going to support it, right? Then it gets blocked at the custom. So how do you debottleneck these things in a very real way so that businesses don't suffer? We go and invest thinking this is the framework, but then in action, it is not getting translated, right? So I think some thinking has to go in, and probably there is help needed that to facilitate it much better. Sorry that I'm taking time, sorry.
No, that's good. Interesting. Okay.
Susan, a couple of questions. Adam Blanco here. Actually for you and for Richard, and if Looney's still on the call, there was discussion about focusing the countries where they can grow, where they can grow fruits or grow the agriculture that is good for that particular region. How do you create the conditions that is conducive to making that happen? And what I mean is from the private sector as well as the public sector, getting the government and getting the private sector to move in that direction where it is more efficient. That's my question to you guys, being that you're on the ground and you know Africa very well from an economic development standpoint as well. Thank you.
You start with the market first and foremost. So you buy a site and the site has to tick a whole number of boxes or you don't buy that site. Proximity to water, proximity to markets, good soils, you do serious soil analysis. There are a whole series of different tick boxes before we'd even look at a site. And once you secure a site, then the issue becomes which markets are close by, which markets have the greatest demand, what crops are going to suit this fertile soil, and what, is it clay soil, what kind of soils does it have? And then you go to the market. And what we do is we look at biological assets first and foremost, because they are forgiving, because climate change doesn't impact them as much. They can take monsoons, trees can take a whole lot more of a battering than say, groundnuts, for example, that are just, right on the ground surface. So we choose our crops carefully. We prefer obviously high yielding crops, high value crops, and tree crops in particular. That requires some time delay because it takes at least a year in the case of bananas, if not 3 in the case of mac nuts and others to bear fruit. But if you don't have the market, you don't have the sale. So that really is critical. The benefit of being in Africa is that because there is so much demand, we cannot keep up with the demand for our food. And we get calls by spice companies in America that are disallowed from buying their spices in Mexico because of drug cartels there. So they then look to us in Africa to say, can we start to buy it from you? I mean, all sorts of different strange stories bring people to Africa. But largely it's because it is a competitive market in terms of production, and it is a very high yielding product generally on the ground. But we are currently being invited to grow crops for groups that are in Europe and elsewhere, so and the Middle East, etc. So there's international demand, but frankly, we could just grow for Africa full stop and fulfill almost any crop that we so choose in the regions where we operate. So I'm saying the market, but what we care about is that the market is close. So we can sell bananas into Mozambique endlessly, but the Johannesburg market pays a lot of money for bananas. So we'll go over the market, we'll go over the border to Johannesburg for part of the load and stay local for part of the load and diversify.
Understood, Susan. My question is also, what is the role that the government plays in creating that environment to allow you to do that in terms of taxes, export policy, those are and capital controls.
Well, for
example,
how
do
of
I
all,
exit?
Everything is delayed. I mean, everything gets delayed because Africa is Africa time. But there was a special economic zone that was finally established in Chokwe, where the banana farm is based. And that took 5 to 7 years to build and to release. But when you start a company in Africa, you get generally the first 5 years are tax-free. You get much cheaper duties over borders when you import any equipment. I mean, there are all sorts of tax breaks when you buy a company, an agri company, when you start a company, when you start a business in Africa that is agricultural, you get a series of tax breaks, and those tend to last for 5 years. So the government is an enabler. It allows these companies, these young companies, to flourish. And taxes are generally quite low. Corporate tax rates are generally quite low, like 17%. They're not extremely high taxes generally. Africa doesn't have very high taxes, full stop, even in the southern zone, full stop. It doesn't, it's nothing like obviously the Northern Hemisphere. But the government assists. Where the government falls down is that there are a lot of bureaucratic steps to practice, and there's not a lot of support on funding, full stop, ever. Like, you don't get funding. So you are on your own. You are on your own, full stop. You are on your own. In this whole venture with me, you feel like you've got a couple of investors beside you, and you guys are doing it together.
Adam, I would add in which is the reason that I say you need to get groups like CDC and others together, and trade and development banks, because trade and development banks typically have ties to the government. Most of them loan money or invest with the government, not with a private company. Or if they do with a private company, it's guaranteed in some way by the government. But if you do that, then the investment becomes the equity in that investment becomes partly the government. So it's less incentive for them to close the borders for you to sell your product. It's a disincentive for them to raise taxes, change policies, do other things that would mess up that investment, because they're a part owner in it. And so while I don't really like having businesses, quite frankly, where a government is a partner, it does help sometimes to have a partner that's a development bank or a CDC or an FMO or what have you, because they know that as a partner, it's like what we do with World Food Bank. While we're a for-profit entity, we're treated much like the Red Cross in many countries, because they see us as an enabler of ag development. And so if we're trying to transport stuff across borders, sometimes we get a little bit more favorable treatment, because they see us as assisting the farmer, the small farmer, to get to the market when they couldn't get to the market, to get food to the people that are in refugee camps that normally wouldn't be able to get food or what have you. But that tie into that helps open up those borders. Whatever we're able to do on a structural basis by partnering with development banks and DFIs, I think would help. But rather than, and you know, to Susan's point, what ends up happening is you spend 5 years to get that one partnership with one DFI to do one project. And then you spend another 5 years to do another one. Well, I'll be 173 by the time I actually have an exit, if I have to do that, right? So, because I'm 171 now. But there, if you had it, that's why to me, if you have a systemic model where you have CDC, FMO, KFW, USAID, and all these others, World Bank, IFC, all coming together saying, we're going to attack this, we're going to push money into the funnel, and then it goes through and you have managers looking for projects and programs or what have you, but they're doing it in collaboration. Then you do a deal, and then you do another deal, and then you do another deal, because it all fits into the system, and they're trying to find things to plug into that piece. What happens is they end up doing it as kind of a one-off, and then they find another one that's a one-off. And we have that same issue at USAID. We have people doing research on maize in Uganda to find out something that we actually did that study 5 years ago. And as a former trader, we always say it's not the data, it's the delta. It's the rate of change in the data. It's how it's different this year than it was last year. And so what we really need is those larger organizations partnering with the mid-sized organizations that also, many of them are off-takers, the Sainsbury's of the world, the Lillys of the world, the others that are buyers of those products, and they come in and they make longer-term commitments. Because by the time it takes you 3 years to build a factory, and then a year after you build it, Zimbabwe, Zambia says we're no longer exporting maize. You have to shut down all your factories you just finished building. But if you're a partner with a development bank and you have some influence, then they may not pass those laws. And the issue, quite frankly, that we're seeing in the United States is the same, is people used to invest into places that sometimes weren't the best to invest, but they had consistency. I knew that when I invested in this area, the laws were going to stay the same. And if they changed, it would take 3 or 4 years before that would actually come to fruition. Where in other markets, it can change in 6 months, it can change back a year later. We need to get people to build consistency. And that to me comes from a systemic level of integration. If you're able to get the development banks and the governments and everyone together, it's hard to untie that knot.
If we didn't have development banks, there would be very little progress in many of these projects. Development banks at least give some money to some of the projects, but as Richard said, there's a funnel, and that's where the clog happens. The clog happens before it is distributed at a grassroots base through different networks. So I'll knock on banks' doors and I'll say, I understand that you, bank, I did this recently actually, I understand that you, a bank in Zambia, are working on the 2X challenge for funding women in agriculture, funding women in business actually, and very helpful, but did not have the funds funneled through. There was no funneling effect. And if the DFIs can work through banks on the ground, and if that is headlined, then groups like me can say, gosh, I can go to that bank and I can borrow at a better rate, like 4%, which is reasonable, as opposed to 12%, which is pecuniary. I mean, I can't possibly do that. Then you can get traction. It's very difficult to get traction to find these pockets of funding.
That's an interesting point, Susan, and to the point Richard made earlier. Increasingly through our financial services group, we are actually taking this intermediate route to address some specific area or theme of impact, such as the 2X challenge that you talked about. And given the fact that especially in food and agriculture, a predominant number of women occupy the upstream part of the value chain for a number of crops. So we're actually initiating that. And to the point, Richard, you made earlier, I think it's very important. In addition to, as you talked about the multi-stakeholder approach, in addition to the DFIs, we need some of the multinational big boys, like you mentioned, Sainsbury's or the Krogers of this world, the Tesco's of the world, to come in a partnership. It will require a number of co-investments. Has to be a partnership approach. This is the way we are approaching not just the food and agriculture sector from a CDC perspective, but across a number of other sectors. We need to partner with the like-minded institutions. For instance, in order for us to deliver on one of our strategic investment themes in food and agriculture, which is on the scale and inclusion, we need to operate a vertically integrated value chain. But foremost, anchor to this value chain has to be an off-taker. a long-term off-taker is usually one of the large food multinationals or regional champions. So I think we, as we move forward, we need to think of some creative ways of how we can all work together through this platform to bring some of the big boys, so to speak, the off-takers, because there's certainly a lot of opportunity from Africa. And going to the issue of comparative advantage, I think if we take a focused investment approach and focus on implementation on the ground and have the right sequence of investment, certainly we can derive a lot of, make Africa deliver on a number of competitive and comparative advantages for a number of crops that they can supply to the international markets, and at the same time address the food security issues.
Yeah. Well, I hope that after this session, I mean, Sammy, that is really good news, because if ever you need myself, and I'm going to let you too, Richard, to get involved in any way in this, and I mean, I will speak to Sainsbury's, I'll speak to anybody, but I know on the ground as an operator, I've done this for so long now, I really do get how this fails and how it works. And it is heavy lifting for people on the ground. And yet the opportunities are vast with really skinny funding. So we're not talking about $10 million even, we're talking about 5 million or less for a few farms. It's really not huge. So it's more just making sure that groups like us and others, and there are many others, that would benefit from 10 million and under and get those tickets and can start to thrive. I mean, really expand with speed as opposed to organically. You know, we are growing at a very nice clip, but it's slow. What we want is expansion capital to really hit it and to grow. You know, double the speed.
Susan, you mentioned that the DFIs need to be more involved with the US, well, not USAID, but the World Bank, those kinds of organizations. Where in Africa are they most active, and what kind of programs are those? Are those credit risk? Are they providing risk capital? What are they doing? Is there a star? Is there a model in Africa?
Well, Sammy, you would probably, Sammy and Richard, you probably have a view yourself on this, but just my very brief view is that the bank that I see trying to assist and really giving it a good go is the African Development Bank, but the tickets that it can write are frankly substantial, like $25 million and $20 million. So $20 million is actually going to, you know, frankly, buy you 3 farms and give you expansion capital. So it's quite a lot of money, and we don't need $20 million, but they need to have bigger tickets. So it comes back to the same old chestnut.
I think from my perspective, some of the DFIs that are quite aggressive in Africa, it goes without saying, are the IFC, CDC, and Proparco. In terms of food and agriculture, in terms of percentage of our total assets under management, I think we are probably the largest, and this is all public information. We have as of latest count, our food and agriculture investment portfolio right now stands at about $650 to $700 million. Out of which 80 to 85% in Africa. So we have a largest percentage of our food and agriculture investments concentrated in Africa. And that's also for legacy issues. As you know, we started off doing a lot of pioneering stuff in Africa in the 50s, 60s, and 70s. And early on since our inception, we were doing a lot of work in Southeast Asia as well, when those markets were still classified as fragile emerging markets.
And Adam, I mean, just to go back to your question, Adam, I agree with you entirely, Sammy. I was actually not even considering the DFIs, because you'd asked about the parastatals, you'd asked about the World Banks and the big, you know, the African Development Bank. The DFIs are the lifeblood. I mean, the DFIs, you know, the FMOs, the CDCs, in fact, in order: CDC, FMO, Norfund, probably not even in order.
Even Proparco, yeah. Proparco. Proparco does a lot of investments for legacy issues in Western Africa, in Francophone countries.
Yep.
But as you know, we do partner with a number of DFIs in whether it be direct investments or through intermediate funds through the GPs.
Yeah.
Sammy, have you had much work recently with DFC?
That's a good question. So under the new creation of the DFC or the erstwhile OPIC, we have started engaging with their food and agriculture team. I believe that they're working very closely with US aid, and they're getting funding from US aid. Right. And so early stages of discussion, but just to let you know, we have embarked on a strategic collaboration with the IFC for food and agriculture in Africa. And this strategic collaboration exercise started sometime middle of 2020 during the peak of the pandemic. The whole idea was to see, given that we are the two largest DFIs when it comes to African agribusiness, what can we collectively do together, exchange ideas, and that culminated in about 5 investment work streams focusing on things like high value crops, on animal protein or ag-tech, so on and so forth. The whole idea is to look at potential co-investment opportunities where possible through sharing of pipelines, but more importantly, looking at the bigger picture over the long term. How can we, work together and collectively to make a long-lasting, sustainable impact in the continent?
Sammy, are any of that collaboration, and Susan, everyone, I guess, are any of those programs funding through the banks to lend out to SMEs? Is there anything like that in Africa?
Yeah. So that's a good question. I know IFC has its own programs. As part of our strategic collaboration, we have identified 5 investment work streams that don't directly but indirectly tackle smallholder farmers and SMEs by means of an integrated value chain. But through our trade access facility, which resides under our financial services group, we have programs with banks. I think local banks, Absa Bank, Standard Bank, where we do lend them facilities that are onward lent to SMEs because they have the capabilities, people on the ground, to do the various credit checks and so on and so forth. We don't have the manpower. So out of the 500 people that we have in CDC, I think about 300 to 350 are London-based, but as part of a new strategy cycle moving forward, we'll be recruiting more people on the ground. And one of our sister concerns, which you may be familiar with, is AgDevCo. So AgDevCo does a lot of work with SMEs. Previously, they were more grant making. Now they're moving towards the venture area, investments between $1 to $4 million or $1 to $3 million. And the growth segment, which is anywhere between 3-4 to all the way to $9-10 million. So that kind of complements what we're doing on the direct side. But of course, as I mentioned to you earlier, we're also doing venture capital, which are much smaller size deals.
What I found with AgDevCo is that they certainly recently, and I mean recently, like 6 months or a year ago, or maybe even a year ago, actually, before COVID took its hold. But they were really much more, in fact, very smallholder oriented. So even though the big farms that we have supply a lot of support to the smallholders in the region, there is very little chance of getting money from AgDevCo, and that's also really frustrating.
No, you're absolutely right. Under their new, the older strategy rather, they were very much smallholder focused, and they were doing a lot of grants and technical assistance.
Yeah.
But as far as the new strategy cycle is concerned, they're becoming a little bit more commercially oriented, and they're focusing on actually looking at both venture equity and venture debt, as well as growth capital through debt or equity. So they're becoming a little bit more commercially minded, moving away from the pure grant mechanism that they were used to. But by and far, they're one of the largest investors in the food and agribusiness space when it comes to SMEs, mid-sized companies across a number of value chains, including what we talked about in high-value crops.
Okay, well, I'll contact them then.
Yeah. One of the misnomers I think that people find, and I was this way 10 years ago as well, is that if we want to help the poorest of the poor, let's help the poorest of the poor. Let's help the 1 acre farmer do better on his 1 acre. But what we found is that that's actually not the way you get catalytic scaled change. You get catalytic scale change by affecting the people that are already in the cash market. The one that has 5 acres or 10 acres or 20 acres, and with the media company, for example, we found that there's a lot of people, as you know, like in Kenya, half or more, 80% of the people that are working in the city in Nairobi actually have family that has a farm. And when they watch the show too, and they go, wow, we're going to use this new fertilizer. I'm going to bring you this better seed, or we're going to do these rows together and what have you. And sometimes they finance it. Other times it's the guy with 5 or 10 acres that tries this new technique or this new seed because he can afford to do it on 1 or 2 acres. And then the neighbor sees it with 2 acres. The next season they do it. And then the next season, the one with 1 acre will try it. But if you teach people with 1 acre, and we have a farm of 8 square miles in Western Uganda, we found that about a third will actually try it. Even if they work on the farm with you, when they go home, and if they have access to the inputs and access to finance, only about a third will actually do it if they have less than 2 acres, where it's the inverse if they have more than 5 acres. So if you really want to effectuate change, you have to take the people who are already in the cash economy and get them to take a little bit of risk. And that actually influences people more so than, some big institutional person telling them what to do. But
it's almost like a catalytic impact or dominoes
It is.
impact, and you can scale up much faster.
So anyway, thank you, Susan. Thanks, Sammy, for taking all the time.
That was
Thank
great.
you.